current situation, many of them have chosen to discover new measures and disclose them in the financial statements. So we are going to start with the industry and accounting analysis. You have the printed slides that I sent like 2 weeks ago. I have added to the presentation today some illustrations from our financial statements. Instead of going back and forth from the PowerPoint presentation to the financial statements, I've just screenshot the important items and I included them in the slides directly. The updated version is on Moodle uploaded, but the printed version that you may have is the, let's say, not updated one, the oldest one. It doesn't include the illustrations. You have them there, you have them on Moodle, but you don't have them printed. So in case you want them to be printed, just let me know, okay? So this is the plan for today. Any questions or any recommendations about how to proceed? I wanted to cover everything in the day before the submission of the group work. It will be tomorrow afternoon. So today we finish with everything new that we have to explain. Tomorrow we will have exercises. We will have like 4 hours. We have examples, case studies, exercises, problems. So you will hopefully have an answer for every question you might have, I hope. And in the afternoon you submit your group work. And then at least you have you are free from something and you have to focus only to the exam for the next week. So this is like the plan for us. Maybe we can start right away, and in case you have any question, we can discuss. So what is this chapter about? Maybe you noticed that I skipped chapter 30 in favor of chapter 31. So basically we should have discussed together about industrial accounting analysis before we mentioned and covered the techniques of financial analysis. Actually, this is like the first step that we have to do. Before we start the calculations of ratios, we have to know the company, we have to know the industry where it operates, and we have to know how this company has prepared the financial statements, what accounting policies it has used. For example, which method to account for inventories, which method to account for the non-current assets, and do they have any impact on the ratios that I'm going to calculate later? So this is like the first step that we need to take before we even calculate the ratios or we even perform a horizontal or vertical analysis. Why I did that, I mentioned I wanted to give you time to calculate all the ratios. That's why I explained chapter 31 first, and then now we have the big picture. We were seeing like very fragmented ratios. Now we can connect and link them all together and give a meaning to the story that the ratios are trying to tell, let's say. So what is industry analysis? It is something that goes beyond actually calculating ratios and goes beyond reading the annual report. Sometimes it's considered like going into other fields or disciplines of economics, knowing the macroeconomics, knowing the industry specific, know the regulation and legislation in different jurisdictions. So it's kind of something that requires skills and also passions to perform. It's something that goes beyond merely accounting, financial reporting, and financial analysis. Actually, it helps us to know the corporate strategy and how the strategy of the company impacts the financial analysis. Sometimes we may wrongly assume that the result of the ratios are outside the impact of the company, but sometimes the values that we have when we calculate the ratios are a direct result of the strategy that the company has chosen deliberately to follow. So there are different strategies, and we are going to mention them today. According or following the strategy pre-selected by the company, the ratios will be impacted as well, and they will really reflect the strategy that the company has chosen to follow. Next, we are going to describe different incentives for annual accounts management. Now, except for the industry analysis, the accounting analysis is the second major topic of the lecture, chapter 30. Accounting analysis implies a very thorough and careful analysis on the accounting policies choices. What has company chosen to apply and why? Is there any incentive hidden there to manage the financial statements? What is also known as financial statements manipulation or accounting cosmetics. There are various names for that. But actually we find many companies that try to manipulate their accounting figures and numbers, and of course if we only calculate the ratios without previously checking for the accounting policies and accounting standards, we will not understand anything about the incentives of the company. Did the company in the first place wanted this ratio to have this value that I'm calculating over here? And this is especially noticed in those companies that have some contracts, for example, debt contracts, and that contracts require the companies to have specific ratios. For example, one bank that gives a loan to one company may impose a strict debt ratio, total debt to total assets, let's say 55%. If the company has a higher ratio than 55%, then the contract specifies that probably the loan should be returned to the bank or probably the interest will go up. So you imagine that the company will try to make its best efforts to keep the debt ratio lower than 55%. So let's keep this in mind when we read the accounting data or accounting information. A very good point that you might discuss right now is that, okay, that these financial statements are audited. So there have been some auditing companies, we read in their annual reports that very important, big and famous auditing companies have audited this figure. They have done their job, they have checked if the company has been applying consistently and correctly the accounting standards and financial reporting standards. Yes, that is true, but it's not in the scope of auditors' work to find earnings management. They are just to control if the company has followed the accounting standards, but sometimes the accounting standards themselves, they have the flexibility of choosing different methods, and this is what the company uses as a means to perform the account manipulation. So don't be sure that if some financial statement is audited, then it has to be true, it has to be correct. Sometimes there are manipulation even to audited statements. We are going to have some illustrations later today. We are going also to describe some variables or factors that they increase the accounting discretion of management and identify the practices that are most popular and are mainly used from the managers for annual accounts management. So basically, what do they do? When we talk or when we cover the accounting manipulation, we have to understand that there should be three factors over there. First of all, it should be the motives or the incentives. Do the managers have a motive to manipulate the accounts? And we will demonstrate that yes, they have not one but many reasons why they should manipulate the financial figures. Do they have the possibility or the opportunity to perform any account manipulations? They may have the incentive, but actually are they given an opportunity to exercise their incentives and intentions? Actually, we will demonstrate that yes, there are many opportunities that they have. And the last factor is, what do they actually do? They have the motives, they have the opportunity. It's like we are investigating here, but this is almost an investigation on financial manipulation possibility. So the managers have the incentives, they have the opportunities. Actually, what do they usually do? Can we see traces of their violations in financial statements? Knowing their usual methods of performing manipulation, can we check that through financial ratios. This is like what we intend to do in this chapter today. Okay, so the contents very briefly: industry analysis that I mentioned, accounting analysis. These are like two big parts of the chapter today: industry and accounting analysis. Which is the available accounting discretion? So what are the incentives and the opportunities given to the managers? Then we will cover the entity analysis, which is basically a combination of different ratios and how to understand the entity performance through this ratio. We will mention something about the reversal effect. Actually, almost every manipulation method that the managers can use does not have a long-term effect. Somewhere in the future it will be reversed. It will be undone. And this is usually linked to those account manipulations that are basically only accounting based, which is something that is true in almost 70 or 80% of the cases. The other part, 20 or 30% of account manipulations, really is linked to real transactions, and they are not reversed in the future because they happen in 1 year and they are not going to be reversed somewhere after 2 or 3 years later. So the reversal effect, which happens in almost, as I said, 70 or 80% of the cases, is mainly linked to the manipulation related to accounting applications only, not to real transactions. And that is important because we know that whenever a company comes out as a very successful one for 2 or 3 years, and this is because of the account manipulations, after 4 or 5 years it will go down very quickly because of the reversal effect. It doesn't last long. It will be uncovered or it will be undone in the future. Something that we are going to mention very briefly, but then explain in detail in the next chapter, is about the non-GAAP measures. Non-GAAP measures are ratios or indicators that are not based in financial information, and actually we know them as alternative performance measures covering sectors like environmental or social inclusion of the company. Actually, this data usually is not audited. That means that please be very careful when you read non-GAAP indicators. They are not financially audited or controlled by an auditor, and that means that you should be double dubious and really thinking and checking very carefully the quality of the information that is included and reported there. And also the non-GAAP disclosures, they are basically at the discretion of the company. That means that the company chooses what to disclose. And usually, as you may think, they will choose to disclose and report indicators that will make them look good in the eyes of the potential investors. So please don't be lied by these indicators, but be very, very carefully how to read through this information. We are going to explain various accounting and regulations that are trying to be presented in the environment in the recent years. Okay, so let's say something about the industry analysis. As I mentioned, actually this implies an analysis of the business environment encompassing different factors that are listed over there. For example, the company may choose to have different degrees of competition, and that means that if you analyze companies in different sectors, they may be faced with different degree of competition. You have probably discussed even before about a different kind of competition like monopoly or monopoly is a kind of market when there is only one player, so there is no competition at all. But also on the other end, you have the free competition. There is a market where there are many players and you cannot decide actually the price of the product. The price is decided by the market, the interrelationship between the supply and demand in the market. So when you analyze the company and you perform an industry analysis, you have to carefully understand what kind of market is your company operating. Is that a monopoly or an oligopoly when there are major big players, big companies, in a limited number, 5, 6 of them, or is that a free competition market? So you have to check that and apply to your own companies. For example, if we are analyzing Carrefour, actually we may think that it's a free competition, but actually in the sector of large retailers, it seems like a mix between free competition and oligopoly, because there are several major retailers operating there. So we have to think about that. Usually the company discloses some information about the competition market in their own management discussion and analysis. If you read carefully the first pages of the annual report, you may find the executive letter or the management discussion and analysis or management letter, and you find something there mentioning the degree of competition or the sector where the company is operating. Okay? There is no need to go and be very detailed about that. We just want to know what the company is facing, what are the competitors, and how big is the pressure that they put to our company concerning the quality of products, concerning the prices, the delivery times, and so on. Something else that we need to know when we analyze the business environment is the price as related to the cost structure in order to utilize the production capacity. Actually, there are different discussions as to how the price is connected to the cost structure. We haven't had the opportunity together in this course to discuss about the different cost structures a lot, not as much as I would like us to discuss. There are costs that are classified as fixed and variable. You know the difference between them, right? So the fixed costs are not flexible in the short term, and sometimes some of these fixed costs are not flexible even in the long run. That means that if you have made some big investments and you are tied with this fixed cost for depreciation or amortization, you are usually you have very high incentives to utilize your capacity and the infrastructure where you have invested in, and you are ready to apply even lower prices in order to utilize the capacity. The perfect example that is usually given there is the sector of airlines or the air travel. They have invested in their fleets, and so they have to utilize this capacity. Therefore, we can see very low prices sometimes applied by big companies. They've already invested in this infrastructure or the fleet or the aircraft, and they have to utilize that. That is where we have high fixed costs. Sometimes we are really very ready to apply lower prices in order to engage and utilize and use the full capacity. Whereas if we have variable costs more than fixed costs in our cost structure, sometimes we do not have any incentives to apply lower prices, because with lower prices you will have also higher variable costs, and then the profit margin will be lower. The variable cost, for example, in the airline industry that I took as an example, the variable costs relate to the salaries of the staff, the staff of the fleet, and also the administrative staff, and also the cost of operating in different airports, as they are related to the actual number of flights that the company is offering. That means that the more you sell, the more flights you operate, the higher the cost will be. So we are not really very motivated to offer many flights because the cost will go up. Whereas if you already have some high fixed costs, the more flights you offer, the lower this fixed costs per flight will be. So sometimes we have to think about the cost structure that the company is applying. I am really aware that this is not something easily discernible from the annual reports. Sometimes in the annual reports it's very difficult for us to understand which part of the cost is fixed and which part is variable. But sometimes in the disclosures or in the notes, you may find some further information about that. For example, if you read about the cost of amortization or depreciation, you know that that is fixed amount, and maybe you can compare the cost of amortization, depreciation with the total expenditure, operating expenditure, and see what part of the operating expenses is actually fixed, like amortization, depreciation. Something that is also a fixed amount, a fixed cost, is interest cost. It's not operating, it's financing, but it is also fixed in the meaning that it will not change in the future. Even if you don't produce or you don't sell anything, you still have to pay the interest expenses. The same as with other fixed costs. So try to see or try to understand the cost structure. You are not required to do that for the group work. You are only required to do that just to have an understanding about the cost structure of the companies. What we are trying to say here, to summarize all this long discussion, is that the companies that have a higher percentage of fixed costs in their cost structure are more risky companies. Usually they are considered to have a high operating leverage. Be careful, the operating leverage is not the same as financial leverage. We are talking about a different kind of leverage here. Operating leverage relates to the companies that have high fixed costs, and usually they are companies that have high or a very large number of non-current assets. And these companies take much risk because if the company, if the sector or if the economy goes down, has a decrease, has a recession, then the company will suffer many losses. So the higher risk they are taking is going to reward them if we have an increase in the economy overall, but if we have a recession, then the risk will bring them down faster than the other companies. Whereas the companies that have low fixed costs and higher variable costs in their cost structure, they are considered to be less risky. Why? Because they are more adaptable to the changes in the economy. If the economy goes down, their costs are variable and they can change, they can adapt more easily, more quickly. So this is something that we also have to consider about the company that we analyze. Something else, and we are done with this topic. It's not easy for your group work project to analyze the cost structure for one other reason, except for the very few disclosures in the annual financial statements. There is also the problem that you are trying to analyze consolidated information. So there are many companies mixed in there. You may have manufacturing companies with a bank that are consolidated together and they are reporting information together. So it's not very easy to analyze cost functions. But if you are dealing with only one company, with only one kind of activity, for example, only manufacturing or only merchandising, then you can do this analysis of the cost structure. But if you are dealing with a company that is consolidating, for example, Carrefour company, if you check their financial statements, of course they have the retailing, the supermarkets, let's say, but they also had some companies dealing with financing the clients. So basically a financial activity, like a mini bank in there. It's not easy to analyze a supermarket which is merged and consolidated together with a bank. So keep this in mind as you try to understand the context and background of what you are doing. Of course, this is pretty self-explainable, high or low barriers to entry. This is one of the reasons why the companies do not want to disclose many informations, because as they give more details about their especially their profit margins, their information is going to be checked and read by their competitors, and they will come in this market and try to enter. So if some markets are attractive, they have high profit margin, more and more competitors will try to get in. The barriers may be of different kind of nature. The barriers can be cost barriers. For example, to enter in the airline industry, you need to have many investments, which is not easy. There may be legislative or legal barriers. You have to comply with different standards. So that is a high cost to comply with to begin with a certain business. So if you analyze the barriers to entry in a certain market, then we can also have an idea how the potential future performance is going to be affected. For the moment, this company may be very profitable, but if it is profitable right now, maybe other competitors will join in later, and after 2 years, if the barriers of entry are low, after 2 years, the situation will not be so rosy as now. Okay, so we have to keep in mind the barriers to entry in different sectors. No problem to enter in the retail market, like for example Carrefour that I'm mentioning very often, but it's not so easy to enter in a market where Peugeot was operating. Okay, so this is also something to consider. Of course, the relation of the input and output market of the firm, they are also something that we have to keep in mind because it takes time to consolidate these markets. Where do you find the labor expertise? Sometimes to perform in very important sectors or industries, you need some specialized work, and where do you find that? It's not all the work not technical or unskilled. You need some specialized workers in very specific industries. Do you have access in the labor markets to have specialized work and labor, and also qualitative and reliable employees? What about the access in the capital resources? Do you have access to take funds, whether by issuing shares or by raising debt and loans through issuing debentures, for example? And also the relation that you have with the supplier chains. Sometimes it's very important to have very good connections with suppliers on one hand and with customers and distribution channels on the other hand. You may perform very well with producing and manufacturing, but if you don't streamline the interrelationship between supplier and customers, everything will be lost. If not, if the raw material is not received in the due time, and if the finished product is not delivered in the right time to the clients and customers, the increase or the extra value that the company is trying to generate will be almost zero. So the relation, or where do you put yourself in having these inputs, labor, financial capital and suppliers, and how fast you are to deliver the product, the output to the market, they are very important. Consider the farming market. You consider all these farms that produce their products. If they do not have distribution channels that are very fast to distribute the product to the clients, everything would go down. So this is the importance of being connected to very fast and flexible distribution channels to access the output market. The customer concentration, okay, this is also very easy to understand. If you are dependable on 1 or 2 or 3 big customers, then you are in trouble. So please check the financial statements. Whenever you have the note that explains the trade receivables, in the statement of financial position, you almost always will have a note or a reference number and disclosures about what trade receivables or account receivables represent. And usually they will provide information if this amount of trade receivables is linked to customers in a specific sector. For example, if 60% or 70% of the trade receivables comes from the energy market, and the energy industry is going down or have some recession, then you will also experience the same problems, because they will have financial difficulties, they will not pay you back, you will reflect their problems or their difficulties. So the customer concentration, or the level of dependency that you have on certain industry or certain specific customers, it is also to be considered here. Sometimes this is especially important not for your group work, because these are very big companies that are consolidated various activities over there, but if you analyze specific companies that mainly work for one or two clients, consider the outsourcing activities to Eastern countries. Usually the companies over there work for a big company in the West providing or outsourcing their activities only for that. So they are almost dependable in only one customer. So consider this whenever you analyze the data and the information. Again, this requires you to go and read the notes and disclosures, and sometimes the information that you need is not even there. So again, this is something that goes beyond the financial information and requires you to check, read on the internet, read on the webpage of the companies, something that I'm not requiring you to do for the sake of the group work project, but to have, I want you to keep in mind that whenever you are probably required later to perform a deeper analysis, this should be like the contextual background that accompanies a deeper analysis, let's say. The second part of the industry analysis makes us focus in the business strategy and the corporate strategy. What is the business strategy? There are various approaches and methodological frameworks to analyze how the company achieves profit. How is it successful? The business strategy will depend on the products or services, will depend on the type of customers that it has attracted and with whom it has had business relations. Actually, the company may achieve competitive advantage through either low-cost approach or product differentiation. I think that you have also listened or known before about these two approaches. They are very famous, and they are introduced by one scientist, Porter. Porter, back in the 80s, he argued that the companies can be successful and be distinguished from other competitors mainly through one of each of these two courses. They may either choose to offer products that are basically the same with other companies, but offer them at lower prices through having lower costs. And these companies that achieve the success through this method, they try to operate by producing in bulk in big quantities, and also by keeping their costs down, negotiating with the suppliers for cheaper prices, outsourcing the production processes in countries where the labor cost was low or cheap, and so on. Whereas we have other companies that try to achieve success not through offering the same product with a lower price, but through offering a specialized product, a customized one. And this is product differentiation. They try to achieve a different image, and so they try to make their customers be loyal to them through customer retention or customer loyalty. So they try to add to their products different features, either through characteristics of the product themselves or through the distribution or offering the service to the client. So this is another way how the company may choose to apply its business strategy. Whenever you are analyzing your company, you have to think that maybe which is the way that it's operating. Is it offering the same product as other companies but at a low cost, or is it trying to offer a slightly different product by adding ancillary services or features that are specific for this company only? The last thing that we maybe need to think of when we perform the industry analysis is to think of all the value chain, the chain of value creation, let's say. How the company creates value. Sometimes in the annual reports, companies usually like to put the value chain or the value creation in their annual reports. And usually you will find like a scheme or a diagram or a figure, very beautiful. We'll show you one later, where they show how they create value. In your textbook is an example of a chocolate company, the biggest in the world, and they show how they create value from collecting cocoa beans and then producing chocolate and so on. So the value chain starts since the inception of the product, since you are researching and developing new products. So since the inception or creation of a new product, then you jump to the design of the product itself, you build a prototype, you test the prototypes until you are ready to put this product in the market. Then you pass to the services or processes, so you prepare the manufacturing floor in order to manufacture or to prepare and offer this product and service. And then you have the production. Now you see that the production stage, the production phase over here, it's not the first one. Usually in the financial and accounting situations, we talk about expenses, we talk about revenues, but both of them, they are usually related only to the production part and maximum to the marketing and distribution expenditure. But you see that the value creation starts so early in time, starts with the research and development. Usually we have in the financial statements research and development costs and expenditure, but they are not allocated to inventories as we saw in the IS2 standard that was treating the inventories. They are not allowed to be allocated to inventories. They should be recognized usually as expenditure of the period unless they are connected with a future project that will bring income to the company. What we are trying to say here that the value chain has many stages and the product is gaining value or is being more successful as it passes through these stages. Companies disclose the value chain creation in their annual reports. I think that I have included one later, let's see. And the cost drivers, okay, that's also really interesting if we were to talk about costs. I mentioned to you that I would like to have more time to talk more about the cost structure and cost drivers. What is the cost drivers is something that makes the costs go up. What causes the expenses in your company? What makes the costs happen in the company? We want to keep the costs and expenses under control, right? We don't want them to be very high. So we have to know the cost drivers. What is making our costs go up? There are two different cost drivers, according to the arguments about some researchers in this field. We have cost drivers connected to the actual output. The cost drivers that are connected to the actual output usually are cost drivers that cause or make happen the variable costs. For example, the more you manufacture, the more material and labor you will use. This is the number of units you have produced. It's a cost driver related to the actual output. The more you produce, the more output you have, the higher the costs are, okay? But sometimes there are other drivers that are connected to the output capacity, not to the actual output, how much you are producing, but how much you are prepared to produce. You remember the normal capacity and the theoretical capacity that we discussed early at the beginning of our course at the standard of inventories. We discussed about the normal capacity. The normal capacity is the normal output or the normal number of units that the company may produce over a long run, on average. That is the infrastructure what I have invested in. Even though I do not utilize fully this capacity, that means that these costs will not vanish, they will be there. For example, the depreciation. We have purchased the inventory. Under the straight line depreciation, we will depreciate this equipment, not inventory. We will depreciate the equipment even if we don't produce anything. So these are the cost drivers that are related to the output capacity, not the actual output. And something that we need to keep in mind is how the company has chosen to comply with these two together. So it's not something simple, it's very complicated in practice, and this is something that actually the management accountants deal with, not the financial accounting, but management accounting. But still we have to know that there are different cost drivers that cause variable and fixed costs. Actual output contributes to the variable cost, whereas the output capacity usually contributes to the fixed cost items. Okay, so this is something that, again, I think this is part of the textbook, yes. This is an example of the aviation industry, SAS Group. They have demonstrated over here the trends and changes in this industry and the interconnection with other network airlines, with the distributors. You can see that the distribution channels over here are travel agencies, internet services, and other intermediate services. Aircraft manufacturers are listed here. Aircraft manufacturers are kind of suppliers for these airline industries. So where can we purchase an aircraft? Basically, there are three categories listed over here. For each of them, we have the EBIT margin. So we have to know about our suppliers, which are the margins they are operating in. And this information is provided here. What I was saying, usually the industry analysis, a summarization or a beautiful depiction of the industry analysis is included in the annual reports. So if you are lucky, you have for your own companies readily available on industry analysis, which are the suppliers, which are the leasing companies that also may offer aircraft on lease, not to purchase, which are the airports that we may operate the services, the ground services also offered in different airports, and the companies that deal with technical maintainers of the aircraft. So these are like the identification of key actors regarding suppliers, partners, customers, and services that we need to provide from the market. Again, this is an example in the textbook, so you can check for yourself. What I've included here, I told you that instead of going back and forth from the PowerPoint presentation to the annual report of Carrefour Group, I just copied and pasted some screenshots so it's easier for us to stay in the same page. So Carrefour business model, if you check the financial statements, the annual report of Carrefour Company, it's one of the companies provided in the beginning of this course by Professor Busso. They explicitly state their business model. They do not make you think or search on making the analysis by yourself. Of course, if you are in the real world, the financial analyst will do your job and search further. But for the case of this group work project, that is already there. So basically what Carrefour is stating here is how they create value. You remember the value added of the value creation process, starting from the design of the product, then research and development, and so on. So the company really explains how they create value and what their business model is. And they declare here their intention to abide by the United Nations Sustainable Development Goals. We'll say more about this later in the non-financial reporting. So I'm continuing. This is the beautiful picture or the diagram that I mentioned. Usually companies use these diagrams. In the textbook you have the diagram not only of the airline company that I included, but also of the chocolate manufacturer. And this is for the Carrefour, what they have put in there. They have included the challenges of the 2 recent years. And the challenges are basically new eating behaviors. They are seeing that the customers are trying to be more careful what they eat, the quality of the products they consume, and so on. Consumer behaviors transformed by digital technology. More and more people are buying online, even if it is groceries. Duty to provide affordable, healthy food. Revisiting the agricultural model. That means that there are different regulations that sometimes require you to buy locally or to have connections with local suppliers. The need to preserve natural resources, this is like an intention or one of the goals in the United Nations CDGs that we are going to mention also later, and more intensive competitive pressure from local companies. You see two main pillars over there. The first one is capital and resources. So where a company finds its resources to perform its activity and what is the capital that they use. According to the non-financial framework, non-financial information reporting framework, the companies have to disclose information about the financial and economic capital, but also about the human capital and relational capital, meaning all the connections with the possible partners in industry. And you see that there is a lot of information going over there. Whereas relating to the creating value, the same classes or the same categories of the capital, financial, economic, human, intellectual, and relational capital, the companies are trying to declare how much are they spending in each of these categories to raise value or to create value. I know it's not very clear, but each of you have the annual reports of the Carrefour company, and you may check for yourself. The idea is that they show there how they create their value, and in the middle of the diagram there is a picture of how they interconnect. They are in the middle of connecting consumers, farming, factories and plants, and so on. Okay, and I think this is the last. They also state the business strategy, that is how they achieve their profits through, remember we have two basic strategies, low cost or product differentiation. Actually, the company states that to build a sustainable model, they are focusing on 4 different elements stated over here. Deploy a simplified and open organization, a simpler organizational structure. Achieve productivity and competitiveness gains, that is to have more gain and reduce competitiveness. Create an omni-channel universe of reference and overhaul the offer to promote food quality. Specifically, they identify I put in this last slide, they identify the challenges they have for the future performance. And if you are careful for your companies, you may find the same things that they have discovered and stated in their annual reports, usually by the first pages of the annual report. They have identified 7 trends, and also that these trends represent challenges for Carrefour company. Retail's essential role during the whole crisis, and they mention how their role was increased and really important in the middle of COVID pandemics. In France only, it was on Monday, March 16, 2020, an increase of 223% of purchases online, and we all saw that. So companies had this kind of challenge. Amplified food trends, no need to elaborate. The rise of e-commerce, significant price sensitivity. Price sensitivity means that this is like a feature of the price of products in certain markets. Sensitivity, high sensitivity of the prices means that if the price of a product goes of at least 1 small percentage up, the decrease in demand will be considerable. That means that if you increase the prices, the demand will decrease by a higher percentage than the increase in the price. That is considered price sensitivity. If it makes sense, it's an economics principle. Some products are characterized by high price sensitivity because they have product substitutes. Whenever you find that the price of one certain kind of pen is high, you jump to another kind of pen to buy. That's easy. Sometimes some products have a low sensitivity because there are no substitutes. If you are provided for energy from NL, if I'm not wrong, and then the company increases the prices, you do not have many substitutes, so there is no high sensitivity in the price. You have to consider that. But regarding Carrefour, they are stating that they have high price sensitivity because there are many competitors and product substitutes for food, basically. Also, revisiting the agricultural model, this is something that I mentioned even before. There are different changes in the world and global environment about how to produce, how to farm, and the legal requirements as well. So the companies that buy, purchase, and resell food products have to keep this in mind. The need to preserve natural resources and sustain competitive pressure. These are like the 7 trends and also challenges for the Carrefour company. To continue with industrial analysis, the second part of industrial analysis is the corporate strategy. Okay, the business strategy is how you have chosen to operate, how to offer the product, low cost or product differentiation, how do you connect with suppliers, customers, and so on, which are the challenges and how you tackle these challenges. The second part is corporate strategy. How have you chosen to perform your activities, either as one business or multiple business lines? Usually, many companies today trying to diversify their activities. Seldomly you will find companies with only one business type or with only one business line. Almost never. Many companies, especially big ones, they like to diversify their activities. That means that they prefer to engage in different areas, in different sectors. Therefore, you will most probably encounter with companies that have multiple businesses. That is, you have consolidated accounts. You have companies that engage in industry, manufacturing, in energy, and also in retail. And sometimes these big companies also open a bank. And sometimes these big companies also open a media company. And if they are successful enough, they have an NGO as well. So always we have these big companies that almost have everything, and it's difficult to perform a pure analysis. This is why we need the segment reporting. But still, the segment reporting is not enough to give us an overview of what is going on in each specific business line. So the segment reporting is trying to provide the disaggregated data, as we mentioned, but still not as easy to perform the analysis as we said. Useful segment ratios, this is something new that I included in this presentation. It's not something that you are required to do for your group work, be careful, but something that you may want to do if you want to understand it better. If you have the information from the segments, you may be able to calculate this kind of ratios over here. For example, you can calculate the segment margin as the ratio between the segment profit or loss divided with the segment revenue. And in this case, you can understand what is the margin of this segment and compare the segment margins to themselves and understand which of the segment is contributing more to the overall profit margin of the company. Almost always, there are some segments that are contributing more profit, and there are some losing segments over there. So always in the company, there are some segments whose activity is performing well, and there are some other segments or lines that are not performing well. Company may decide later to close or discontinue their activities. But for the moment, you may see that they are having a loss, probably, through calculating the segment margin. Another ratio useful is the segment turnover. Turnover usually compares the revenue with the assets and looks at how fast you are turning over your investment, how fast you are circulating your investment. Or another better way to express that, how good you are using your investment to generate revenue. Of course, you calculate the total turnover rate for the company, but if you see at the turnover ratios for each segment, you can understand which of them is generating more revenue. related to the assets that they have been using. Sometimes the segment turnover, sometimes, not always, can be used as a certain indicator of measuring performance and profitability, also to calculate the bonuses for the managers. So this is a very important ratio to see how fast you are generating revenue given the amount of investments and assets you are having. Another ratio is the ROA. This is definitely used as an indicator to measure performance of the managers of different segments. Usually you compare the segment profit or loss with the segment assets, and you try to understand how much profit have you been generating with the investments that you have been given or been invested or allocated by the company. Definitely the ROA, return on asset of each segment, is used as a measure to compare segments to each other to understand which one is more profitable. And of course, segment debt ratio, segment liabilities, and segment assets. Sometimes it's not easy to identify segment liabilities specifically because usually big companies, when they have loans or debts or issue debentures or bonds, that is in total for the company. It's not related to different segments. So probably the segment debt ratio will be more difficult to calculate because of the information about segment liabilities. I also remind you of something. Segment liabilities are not mandatory to be disclosed in the segment reporting. Only revenue, asset, and profit are. So this means that the segment liabilities may be not an information that you have in the segment reporting. It's not mandatory. The companies may choose to disclose it or not. It depends on them, on the approach that they are already taking internally, because segment reporting is basically connected what internally companies are doing as well. So probably if you don't have information about segment liabilities, you are not able to calculate the segment debt ratio. But again, these ratios are not mandatory for you to calculate or to know, not for the group work, not for the exam, but maybe you'd like to go this way in order to understand more about the segment activity. It's interesting to see how they all connect to each other. Okay, the segment margin measures the operating profitability. A small interpretation over there, like basically what we said with many words in that. Okay, about accounting analysis, we said that today's lecture had two big parts. The first one was the industry analysis, knowing how the company operates, the market, the suppliers, the customers, and so on. And the other, maybe the most important thing that we can connect our analysis is the accounting analysis. So to understand the quality of the information, or the quality of the data that we find in our financial statements, how reliable this information is. Of course, companies have the choice of adopting a business strategy, but also they have a choice of accounting reporting strategy. Where does this choice come from? Remember that IFRS allows alternative treatment almost for everything. For every standard that we have been covering, for every item in the financial statements, we have more than one loan treatment. We have an alternative approach as well. For the fixed assets, we have the cost, we have the fair value. For the inventory, we have different methods to account for inventory, more than two. So remember that as we have choices, as we have alternatives and options, this makes possible the choice of an accounting reporting strategy. This is the strategy that we are following. This is really connected to also the quality of the information. Managers may actually choose accounting and disclosure policies that make it more difficult for the users of financial statements to understand true economic performance. So that may be something in purpose managers are doing to blur or to hinder the understanding of what is really going on. And actually having to do with an annual report of 150 pages, who would not feel lost among that all information? Of course, managers are saying, we are complying with all requirements of the IFRS. Everything is there. But of course, something may be misrepresented or connected, not in a very clear way, not to help us understand. So sometimes managers do this, of course, and what is worse, they may even may choose accounting policies that misdirect the opinion and analysis of the users of financial statements. We'll see several examples later how they do that, why they do that, and how are they able, how they have the opportunity to do this. Remember, the purpose of what we are going to explain later is to understand the incentives, the opportunities of the managers, and also the mechanisms, the tools, the techniques they are really using to apply accounting cosmetics. Okay, I see that it's time for a short break. So first, before we jump to the account analysis, which is really interesting according to me at least, I think also you'll find it interesting to know how managers manipulate accounts. You are managing the business administration course, right? So please, as future managers, listen to the coming section with the intention to understand what is going on, to read information more carefully. But first, let's have the break, and then we'll continue.
Bem, Kimberly.
There's another book maybe that has the same name. The is by nature of signature, the process item of the sale is raw material. They are the raw material item. Yes, it is the cost of goods sold. Okay, what I will do, there is no information result, for example, at no time, cost of materials may explain at note 12, personal expense costs. Do they say what part of cost? Can you check? For example, sometimes they say the minimum cost is this part connected to production, this part connected to sales. You see? So maybe. Sometimes they make this connected to different functions. In this case, if I was you, I would consider of financial materials because you basically want to measure the turnover of inventory and payables. So that is information that you need for the turnover of inventory or the inventory names and payables. So it's compared to salaries and wages. Okay, so
Ma per cui erano tutte cose nelle note, comunque erano irrilevanti, cioè veramente pochi, quindi
my glasses. I always forgot because this is big enough. It doesn't have anything. So this is yes, they are big enough, so please include them. So personal depreciation, other operating are part of CGA. Oh,
perché come ho fatto io è diverso.
Okay, so we found these amounts, but I don't think it's where.
Usually it is in the financial statements, somewhere in the notes. It's a piece of information that you really need to look very carefully. You check the statement of changes in equity, the first thing to look. And you check the statement of financial position.
Magari non hai posto.
The equity section.
Magari devi fare la bimba e quindi avanti.
Okay, here, capital stock, 120, it should be there. Always work with the notes. For everything
Yes.
you have the reference
For
number.
information.
And hopefully it is there because as I said, companies may choose not to disclose everything. It makes it easier for us.
We didn't find any problem in the first part, but in this part we had some.
In the first part of the course,
Yes.
where now you are really working with understanding how they are interconnected. You are basically doing the first and the second part. Okay?
Okay, so we have.
See here, it is exactly the number of shares. You see?
And so I may go in the previous financial statement to find the shares of the previous year.
If they have not disclosed that in here, you can go in the previous year.
Okay.
Capital stock.
Non è così user che ho trovato sbagliato.
Okay. It's the same.
No change.
Okay. Thank you very much.
Numero 2. Ho trovato un ma quello di 2019. Quello che ho usato, che ho trovato da tutti questi numeri diverso, ma quello che avevo messo nella pagina 119 non so perfetto, poi tanta differenza. Magari qualche data hai messo meno, perché per quanto lei ha detto che non dobbiamo modificare niente. Quella richiesta. Guarda questo che abbiamo nel nostro, c'è già l'olio e le uova, tutto è diverso da quello che hai.
Vabbè, ma loro usano quei dati lì, non bisogna considerare quelli. Ok. In realtà poi non sono diversi. L'euro e 6 e 10.
L'olio 5 di questo.
E poi proprio
L'olio è 10 perché. Ah, magari
dipende da come l'hai classificato, non è che cioè oggi se c'è uno e noi troviamo 50 non ha senso.
Esatto.哇，你整的我也想上厕所，他说休息几分钟。
5分钟。
没事，给你发视频。
我的天，我
还好吧，宝贝儿。
妈的遇到傻逼货代了，他妈的是。哎呀，那有一只小松鼠。
哦，我每次看到小松鼠都太
它
激动了
在那个，树上。
太可爱了，我觉得。
是，爬那么高。
对。今天还想着约两天吃饭，居然他没来，也挺好的。今天带饭了呗？
带。
哎呀，不错，第一次。
饿死我了。
现在。
因为最近可能姨妈到了，我这一个多周一直吃的特别多。
对对对对。我也上星期我折磨在就感觉吃不饱，就在大姨妈之前。
就一直感觉吃不饱，就一直总感觉嘴巴很寂寞。
对。
唉，拉普琴错过了我们的机会，不能怪我们。
没事，刚好不带饭的那天我们去吃盘尼。
也可以。
跟他一起。
你们小作业怎么样呢？
还可以，但是那东西好多呀，我觉得把它整成1分钟真的很。
1分钟根本说不完。
对啊。
你说了的话，你就会很多重要的东西你根本提都提不到。
对。然后我们那个小组的女生就，我写的那个能反面说那个不是很多嘛，很快。
你也是第12的那个，我也是第12的那个。我还有一个 segment。
我是。
Z score。
11、12。
啊，你们是按这么分，我们是自己随便写。啊。不过因为刚好 segment 跟那个alternative 那些其实是有联系的，在我们那边是有一些联系的。刚好这挺巧的这两个。
可以。
但是真的太多了，我的那个就是弄 financial 那个，我就直接列出来，爱咋地。我觉得吧，就像他说的，很多东西你列在那儿就好，你不用去说，他自己看吧。我就觉得有一些话，可能我就直接是打在那个 PPT 上面，说跟不说就到时候看时间，因为我还没有尝试时间。
You will find this part of the chapter more interesting than the first one. Well, the first one is really big variance, something that you have to check the market, but you don't know exactly what to look for. You gather information and so on. But this is more interesting because also you know what to look for. And I'm starting with an illustration with the Enron company. I don't know if you know the Enron history of almost 20 years ago. Is a big company in US that went bankrupt. Anyone heard about the Enron case before? Don't tell me. Really? Nobody? Enron? Does this sound very familiar now? Tonight you go and read more about the Enron case. It's a famous bankruptcy event in US in 2001, I guess, or 2002, and it became famous because there were accounting manipulation and earnings mismanagement over there, and there were many abuse of the power from the top-ranking managers. The company was having losses, these managers were giving themselves big bonuses, and so on. So it became famous. And also it led to bankruptcy one of the big auditing firms. You know that there are big four, right? The big four companies? Have you heard about them? Well, before Enron there were big five. But the auditing company of Enron, Arthur Andersen, after Enron did go bankrupt and it was discovered that it was manipulating the financial statements. And the auditing company didn't notice anything and didn't report anything. The auditing company, one of the big five in the world, did go bankrupt as well. So this is why it is very famous. And what I represent over here, can you see the data from 98 to 99 and 2000 from Enron, the net income, and also the net cash provided by the operating activities. Also the same data is here, relating the net income and net cash used in operating activities in the first quarter of 2000 and 2001. After the first quarter of 2001, the company declared bankruptcy. Do you see any suspicious trend going on? Net income, net cash provided, or net cash flows from operation activities, CFOs. Do you see any trend?
Goes up.
Okay, you can see that the net income is increasing, and in 2000 is increasing with a very dubious and suspicious amount, but the net cash flows from operating activities is not following with the same step. And what is more suspicious, look at the quarterly information, because sometimes the annual information may hinder you to understand what's going on. This is why we use the interim reports. The interim reports report information related to quarters, and they compare with previous comparative periods. And you see that here we have the complete opposite. The company is declaring net profit, whereas it has negative cash flows. If you remember that we introduced one ratio that was trying to detect manipulation. If you remember in the presentation of the ratios last time, when we included the ratios from the cash flow statement, we said that there is a specific indicator that analysts have found useful to detect manipulation or management of earnings. And this is the ratio between the operating profit and the cash flows from operations. Actually, we should not be based in our conclusions, we should not base our results in only 1 year or in one value, but we should look at the trend of the ratio over time in order to arrive to a conclusion about a certain company. Actually, what I need to also say is that this new ratio over here was introduced and included in the financial analysis due to Enron case. So Enron was the perfect illustration to show us how the negative linkage and relation between the ratios is suspicious and may lead to understanding of bankruptcy. Of course, here we use the net income because we do not have the information about the operating profit, but you can see what is going on, and I put that in red color because this is like a red alert or an alarm for understanding the company performance. So in 98, it was the first year when the adjustments or let's say the accounting manipulations began. The earliest year with restated earnings. After the company declared bankruptcy, it restated the financial statements, and that means that it adjusted the errors and restated figures starting from 98. We see that the ratio between both is 42.8%. Then we see a very huge increase to 72%, and then the crazy year, 2000, 205%. And that is something that really should be noticed and analyzed. Why is it coming? Probably nothing wrong in there. Probably really the company is doing something to defer the receipts and so on. But this is something that should be analyzed. Why the operating profit could be so higher related to the cash flows? Something should really be going on. You know, the operating profit could be, or the net profit could be manipulated through different means, whereas the cash flows, they never lie. You cannot manipulate or change them. Cash flows are controllable. You can go and see when did you get your money, when did you pay your money. There are bank receipts and bank statements that show this. You cannot lie about the cash flows. Whereas you can regulate your profit by simply adjusting the percentage of depreciation, or by increasing the useful life of the assets, or by changing the percentage of the bad debts that you think you are not going to take from the customer. All of these that I'm mentioning are fully acceptable within the accounting standards. You are not violating any standard. The auditors will not charge you with anything if you did that, but still you are manipulating the figures. And what has really disclosed that is this ratio over here. If you are doing all of this that I mentioned, depreciation, provision, and so on, you are increasing the accruals. The accruals are included in profit, but not in the cash flows. And this makes the ratio go high. And especially the red flag or the red alarm that should be blipping is the negative value that we notice in both quarters. 2000 and 2001, sorry for the view, not very clear. Both years, the first quarter, have a negative ratio. First by 74%, and 2001, soon after that, company was exposed and was forced to declare bankruptcy. It was exposed by an internal employee. I think it was a junior employee in the accounting or the financial department. I'm not sure about that. But otherwise, they would not go out themselves. And actually, the top-ranking managers, they went into the court for the Enron case, and they just excused themselves by saying that we don't know anything about accounting and financial statements. We just signed everything that the accounting department was giving to us. So this is why soon after Enron case, there were these big regulations across US and Europe requiring more accountability on behalf of the managers. Right now, who signs the financial statements, if you have noticed the annual report, is the CEO and the board of directors. So they cannot say anymore that I do not know anything going on with accounting, and get the responsibility out of themselves. So this is just to illustrate why the ratios are important to detect the possibility of accounting manipulation. So let's start with accounting analysis. There are three things that we need to mention. The first one is the incentives. Do the managers actually have incentives to manage the annual accounts? Are they really interested? What is their motive and intention in managing the annual accounts? Actually, as described and also shown by various authors and researchers, earnings management can be described as a purposeful intervention with the intent of obtaining some private gain. That means that the managers have something to gain in there. They are doing something to profit for themselves. They are not changing the accounting numbers because they do not know accounting or financial reporting, as the top management of Enron wrongly assumed, but actually they are doing that because they are getting something out of it. Big bonuses, big compensation packages, as we'll see, and so on. So there is an intention every time that the accounting manipulation is happening. Earnings management also occurs when the managers use their judgment in financial reporting in order to mislead some stakeholders. Probably you have heard about, it's not written over here, maybe you have heard about the agency problem or the agency theory. The problem here is that who directs and manages the corporations are the managers and the CEO, and they are really very skillful in their work. Whereas the shareholders, who are the owners of the company, usually they may be individuals knowing nothing about accounting, financial information, or other data. So there is this big mismatch of information between managers. They can take decisions to protect their own position. They are in charge of running the company, and the decisions that they are making, maybe they are not in the long-term benefit of the owners, of the stakeholders, of the shareholders, but they are instead benefiting themselves. So this is the big problem over here. We have managers running the company, being more skillful and having more information about the company, and we have on the other hand shareholders. They are the owners, but they do not sometimes have the power to control the managers. So what do we do about this problem? Okay, so the incentives are first driven by the contract with the shareholders. That means that the managers usually know that the shareholders appreciate higher earnings, and they react with higher share prices and lower cost of capital. So managers, in order to keep the shareholders happy, usually they try to smooth their earnings and report earnings that they are really stable in the long run and increasing with a stable rate. The managers know that the shareholders do not like variability and fluctuation in the share prices. So they do what they can in order to report earnings that are stable over the long run. Usually what they show is the behavior of avoiding the small losses. What has been noticed and observed is usually the companies avoid to report small losses and then small gains, and a small loss again, and then a small gain. This would cause a variability in the profit and would not look good in the eyes of the analyst. Instead, what the companies does is that they take a big bet, and this is known as a big bet accounting. That means that whenever you have to report a small loss, you make sure that your loss is very big, so it will cover for the losses of the years to come. So instead of having a small loss, small profit, small loss, small profit, you have a very big loss, and then you have small profits, then a higher, and that is like an increasing trend, which looks better than having small losses and profits over the year, if you can get the picture. So this is what they call taking a big bet. Whenever you know that you are going to have a small loss for 2020, make sure to make that a big loss. So you take a big bet, you recognize in 2020, for example, every possible negative thing, provision, restructuring, reserves. You account for many losses in 2020, and then you retake the reserve in 2021, 2022, and you slowly but steadily increase the profits. In the eyes of the analyst, this would look very good. It would look like a company from having a very bad year is recovering and is a very resilient company. Instead, it's not. It just took a big bath in a certain year, and now it's just hiding the variability, the true fluctuation of its activities. So this is something that has been noticed and usually happens, especially prior to the initial public offerings. Usually the companies, before they go public or incorporate, private companies, when they go for the first time in the stock market and issue the share, this means to go public or to incorporate, and this is known as the initial public offering. Usually the years before an IPO, what they do is usually this: they take a big bath, report a huge loss, and then steadily recover to have a good impression and to attract as many shareholders as they can. Of course, it also achieves the low earnings volatility, as I mentioned before, and is perceived as less risky. Another thing is that a certain incentive on the part of the managers is to meet the earnings targets and benchmarks. Actually, this is a very cruel reality, if I may say so, because the analysts project the targeted profit for certain companies, and the companies usually try to comply with these targets that are published by the analyst. For example, the financial analyst may make prediction about the market wealth or the market share price about the famous companies like Alphabet or Tesla company. And what the company does in return, it really strives and really makes its effort to comply with the targets published by the analyst. So actually meeting these targets is another incentive for managers to manage the earnings a little bit or more. It depends on the multitude and dimension of the target, but it is certainly an incentive. So issuing share for the first time, or meeting the targets, or keeping the shareholders happy by reporting ever increasing profit, these are kind of incentives that are coming or derived from the contracts that are related to the shareholders. But also there are incentives that are related to the debt contract, not to the contracts with the shareholders. As I mentioned before, there are specific ratios and indicators that are included specifically in the debt covenants or debt contracts. For example, I mentioned the debt ratio not more than 55%. Or for example, threshold of the interest coverage that should be higher than 5 times. Or current ratio should be more than 100%. So these kind of thresholds and indicators that are usually linked to a specific debt contract, that make the company have an incentive to manage the financial statements in order to comply with this kind of conditions, and also try to get favorable credit ratings. There are different agencies across the world that do the credit rating. They are known as credit rating agencies, and they credit rate not only companies but also different individuals as well, but also states and nations. And these credit rating agencies, they give you an evaluation. For example, the best one is 3A's. Whenever you have problems with your debt management, you may have 2A and 1B, AAB, and so on. But depending on the credit rating, you will get favorable or not interest rates and interest covenant conditions. That means that you want to have a good credit rating. In this case, if a company has a good credit rating, in case it requires a loan or issues bonds, it will have a lower interest rate than other companies that have a lower credit rating. That means that you will do the best you can, whatever it's in your discretion, to achieve the highest and the most favorable credit rating you can. Okay? So this is another thing that comes from the debt contract. And of course, there are some contracts that you may have with the government or with regulatory authority. There are special agencies all over related to environmental issues or social issues, gender representativeness, and so on. These are some indicators that you need to comply with, and you are very open to go a step further and change something in the accounting numbers in order to comply with different conditions that you have with different partners in the market. So accounting methods may be chosen with tax in mind. This is something also that makes us change the amount of profit in order to pay less taxes. That's pretty understandable. Some incentives come from the employment contracts, not only from the contracts that we have with our shareholders or the debt holders, but also with the employees as well. For example, the management compensation, depending on the way that the managers are paid, usually the compensation package includes 3 elements. A base salary, which is usually payable with fixed installments over a year. Except for that, they have a bonus plan. The bonus plan is usually linked to performance indicators, and these performance indicators usually include a ROA or ROA, not only for the current year, but also for the long term. And also they have stock and options packages. So they are given options. You remember what options are derivatives or securities that will be converted, in shares with an exercise certain price in a future date. So basically, if you are a top management member, you will have a base salary, you have a bonus, which is payable if you achieve a certain target in your performance, and you also have stock and options that may be very favorable for you if the share price is very high. So what you do as a top manager or as the management of any one company, you do your best to achieve 3 of them. The base salary is for you, it's there always. The bonus plan, you will achieve the highest bonus, the highest or the better the performance you report is. So performance is measured through a ROE, or return on assets, or return on equity. That means that the higher the profit that you report, the bigger is your bonus. Let's do everything to report a higher profit. Now you see the incentive. And also, the higher the profits you report, the higher the share price in the market. The higher the share price in the market, the most benefits come for you from the stock options over there. You can exercise the options with a very low price, and then after you take the shares, you can sell in the market with the market value or the market price and have really a big income over there. So these 3 elements in the management compensation packages have proven to be a very strong incentive for managers to perform accounting manipulation. Is there a way to tackle this? Yes, there are many. Okay, question first.
Why do regulators try not to incentive stock options for companies? Because most high-end managers, the biggest part of their salary is stock options.
Yes.
And so they are...
This is not a very easy question. There are more like 20 or 30 years of research, empirical research in this field by very big minds in this field. Basically, I'm telling the truth. They are trying to find like a trade-off between giving high salaries and also by having a higher percentage of stock options. Like assume that you are the next managers, right? You are going to be the top managers after 10 years. Remember that we discussed this. Assume that you are paid only with base salary. That means that even if you don't work at all, you are going to have the salary, right? Are you having any incentive to give your best to increase the profit for the shareholders? Remember, you are managers, you are not the owners. You only give or you only have or get the base salary. Do you have any incentive to pay long hours every day to have the same base salary as your friend that is working in the other company for less hours and having the same base salary? Apparently not. And that's why to attract the best managers in the world in your company and to keep them and to make them work for your best, because you are a shareholder, you are not working full-time in your company, you are just buying the shares and you are continuing with your life. You want the best from your investment, so you make someone else work for you. And in order to make him, he's a very skilled person. He has studied MBA in Turin University, for example, but he's very skilled and he's trying to work. How do you make him work better for you? You give him base salary and you promise him a bonus plan depending on the performance. So the higher the profit that he manages to earn for the company, the higher the bonus he's going to receive. This has two sides. This also improves the compensation for the manager, but also it gives him incentives to try and deceive you and make something that's not real be presented as if it is happening. You are not very knowledgeable in regard to financial accounting regulation and everything. As I said, you just buy the shares, you continue with your life, but trusting to the managers for their decisions, this is something that is always going to happen. As I said, and also for the options is the same thing. You promise him that if he increases the wealth of you as a shareholder, you will give him options, so he will actually become a part owner of the same company if he has some rights to buy shares. It has proven to be not always true. So still there are people researching what is the best ratio between having a base salary and stock and options and bonus. And how can we connect the bonus plan? Probably if we connect the bonus plan not to the performance of the current year, but to the performance of the 3, 4, 5 years, for example. So as I said, it's a field where there are extensive discussions. If you check your annual report, you will always find very, very much details, and I have also included some here, about how your top management is paid and exactly with their names and the numbers and the amounts of money they have been paid. So they are trying to be transparent about how they pay the top management, but still there are many things to improve there. And the last thing that I would add is that the efforts lately have been to link the options package and the bonus plan that are not guaranteed, they are not base salary, to link them with the performance, not only financial and not only short term. For example, if you were given a bonus only based on return on equity of 2021, that would be that you would really focus on this year. But if your performance-based compensation was linked to the performance over the last 5 years, that means that you will think about 2021, but also about 2022, 2023, and so on. Sometimes the financial decisions have short-term benefits, but in the long run, the company will suffer from the decision of these managers. And sometimes what also happens is that short-sighted managers, they take the short-term decisions to benefit themselves, and then they leave the company, they choose another company, and the next coming manager in the company, he will suffer the consequences because he will uncover all the consequences of the wrong decisions of the previous manager. So again, this is a very interesting field and research to talk about. You can read more if you want, but it's very interesting to know that it's not a really very clear field. are trying to find a midway over there between base salary and the other elements, but it's not easy. It's not always easy because we are dealing with managers which are very skilled. They are powerful people. They know how to manage the accounts, so it's not easy to make them accountable and to have good corporate governance structures in place. Okay, we have more later. Trying to meet the bonus criteria, trying to manage account numbers. We sometimes do that. Avoid management turnover, that means jumping from one other company. And earnings management around CEO turnover, that is something that also happens usually in reality. Before or after when the manager joins the company, we see the phenomena of altering or changing the accounting numbers. That usually happens. Okay, what I included here, I think it's from the Carrefour again, the same company. This is the compensation policy for company officers. And we are having here information, general information about the compensation policy. The board of directors reviews the performance criteria and conditions which are included there. So it is the board of directors that approves the compensation package. You see very specific and detailed information and not confidential, it's with their names in there. You can see that the chairman, later on not the name, the chairman of the board of directors, vice chairman, lead director, and so on. These are the payments only for the board meetings, not the compensation package. Okay, so we have the performance indicators that are linked to the two elements, annual fixed compensation, that is the base salary that I mentioned, and the variable compensation. The annual fixed compensation is payable upon 12 installments over the year, whereas the annual variable may not exceed 20% part of chairman and chief executive officer annual fixed compensation, and is set as 160% of these two positions in a company. So these are all part of the disclosures on compensation package and payments to the top management. Okay, what we can see here is what is the long-term incentive plan. As we said, in order to avoid the incentives of the management to manage the accounts, we have to link the bonus not with the short-term performance but long-term performance. So what they have done in this area, the long-term incentive plan includes stock options, performance shares, or cash, but may not exceed 60% of the gross maximum compensation. So in total, what they may have as stock options is not more than 60% of the total package, which is base salary and the other two components. Okay, so chairman and CEO have a company car. Sometimes the expenses that are related to the corporation activity are covered by the company as well. And other benefits may be provided for a specific situation. Exceptional compensation are also described there. So this is just some fragments and extractions from what a certain company has disclosed about how it pays its executive officers. You can find the same information in your company. In case you didn't read it yet, have a look and you'll find some very interesting figures and what is going on for your own respective companies. It is still discussable about the outcomes and the results of the choice of each of the policy of having to repay these big and top managers. Then what is a big bath accounting? I explained a little bit earlier what taking a big bath means, but basically how it is done is by recording an exceptional one-time operation. For example, a big loss that may have happened due to a hurricane or a flood. We record it in our certain year, and this means to take a big bath. Front-loading of costs, that means that costs that have not happened yet, we record in this period. Actually, they belong to the periods to come, to the next period, but we front-load them. We record them in advance. How that can be? Okay, some standards allow you that to apply the prudence concept in accounting whenever you foresee that you are not going to recover the value of asset you recognize losses. Okay, so you use this phrase or paragraph basically to recognize as many expenses as you can. Recording large provisions, they are also known as rainy day reserves. I like these names. They are basically American, but they are very, they speak very loud. They are called rainy day reserves or cookie jar reserves. Rainy day reserves means that these are reserves for bad days, for not very good years, or cookie jar, you know what that means, okay? And also through recording large impairments of assets that basically are not true at all, but this is a means or a tool for us to record huge expenditure for the current year. Actually, the financial year, as I said, when the big bath is taken, a substantial loss will be recorded, and then in the coming periods we'll have a steady, constant increasing profit. Okay, it is also called with two other names. There are some other incentives to manage accounting numbers, of course. First of all, I would mention the competitive pressures. For example, this comes to avoid competitors from entering the market, to not show the company in a favorable light and to make it attractive for other competitors. Employees. If employees know that the company is earning too much or having high margins, then the employees will ask for higher salaries, of course. And this is especially true in the cases of the company that have union power. So the unions of the employees are strong enough to ask for the increase in the wages and in the salaries. Also to provide the impression to be a reliable supplier. If you want to be in the market and have as many customers as you can, you have to appear as a reliable and safe supplier. So you present your figures in an altered way, just to have a better impression in the supply chain. Towards the community, sometimes the pressure of the community exists and that makes you report figures that are not actually true. The second thing that we have to keep in mind is the opportunities. Okay, we know now, we are sure and certain that the managers have the incentives to manage the accounting numbers, to please the shareholders, to apply with the debt covenants, to please themselves, to take the higher bonuses and stock options plan. But actually, do they have the opportunity to do that? Because I may want to do many things, but if I don't have the opportunity or the chance to do that, that's over. So the next thing that we have to analyze is, are the managers given the opportunity, or have they discretion, flexibility to choose the accounting methods or policies to apply? So let's talk about that. Do they have the opportunity and capability? There are several factors that we need to search in this category. What is the impact of the quality of accounting standards used? Now, we have to think that the companies that use IFRS actually are using a very high quality accounting and reporting framework. Whether the other companies that are not preparing financial statements under IFRS are using a lower quality financial reporting framework. So remember IFRS, and we are all studying IFRS over here, and all our companies are preparing under IFRS. They all are considered qualitative financial reporting standards. Whereas if you analyze companies that prepare financial standards abiding by local standards or abiding by some other GAAP, generally accepted accounting principle, they are not considered as the same quality as the IFRS. Okay, so first of all, in deciding the available accounting discretion, the first thing is what they choose to abide to. If they are choosing IFRS, they are choosing a high quality financial reporting standard, and they do not have many room to apply any accounting manipulation, but still there is some, even though the IFRS is applied. The low quality standards are usually found in countries with a code loss system and a creditor protection. Second, be careful of the institutional characteristics. Usually these are countries with low investor protection. low risk of litigation, low degree of enforcement of the standards or of the laws, and they usually are characterized by lower accounting quality. This is demonstrated by empirical research. That means that there are studies that have been done, and they show that if you have two different companies in two different countries, they both apply IFRS, but the first country is a country with high risk of litigation, high investor protection, high degree of enforcement, it has higher quality. Whereas if you have a company applying IFRS, but operating under low investor protection, low risk of litigation, and so on, still the accounting quality will be lower. So don't be sure that IFRS only is enough. The country it is being applied to is also a very important factor, because sometimes in some, I can mention an example. If you are applying IFRS in a country where there are no penalties for not complying with IFRS, no company will have an incentive to fully comply with this set of standards. Whereas in EU, you have to apply IFRS if you are a big company, but have penalties if you don't abide to this rule. Okay, so it's high degree of enforcement, let's say. Company characteristics also are very important. That means ownership structure. It is concentrated or it is dispersed over different kinds of owners. You have one major shareholder, so you have 1,000 different shareholders. Is it listed or non-listed? Usually the listed companies have major exposure to the market and are better regulated and have a higher quality of financial reporting standard. Whereas the non-listed companies, that is the private companies, not public, the private companies are less regulated, less controlled, and have lower quality of financial reporting. Also listed companies, okay, I said that. Board characteristics. This is also important because sometimes we forget to search for the board of directors. There are empirical research results that say that these factors over here have a direct impact on the quality of financial information reported. Percentage of independent directors. Which are these independent directors means that these are coming from outside the corporation. The independent directors are part of the board of directors, but not part of the company. The more you have in your board as a percentage of independent directors, the higher the quality of reporting. The presence of audit committee. Not every company has an audit committee, but those companies that do have an audit committee that audit the internal control procedure and guarantees good and sound structure of governance, internal governance, that means that we will also have a higher quality financial information reported. The CEO duality. Sometimes the CEO, Chief Executive Officer, is in the same time the chairman of the board of directors. So he is occupying two positions. He's controlling himself, his own operation. Whenever you see that CEO is also the chairman of the board of directors, something's not going on okay there, because this person will not be able to be objective to control his own activities and performance. Also, a factor to consider in the accounting discretion is the auditing from one of the big companies. Now, this is to be discussed. Actually, it's not for certain or for sure. As we mentioned, it was Enron company that was audited from Arthur Andersen, and yet it managed to hugely manipulate the financial statements for at least 3 years in a row. But actually it is accepted in wider range. Then the audit quality performed by one of the big 4 companies is considered more qualitative. So whenever you see financial statements that are audited by KPMG, Ernst & Young, Deloitte, and Pricewaterhouse, these are the big 4, you can assume that the quality of the financial information is higher than the other companies that are audited by other auditing companies. Now, this is not something I'm saying, but this is out of empirical research. So there have been studies in the market, and they have come up with this result over here. Okay, so now we are sure that the managers have the reason to perform manipulation. They have the opportunity, depending on the structure of the board, depending on the standards, depending on the country, depending on whether or not there is an internal audit committee, or if they have a big four to audit or not, and so on. So they have the opportunities. Actually, what do they do to perform or to manage the accounting numbers? Okay, the methods are basically can be categorized into three broad categories. The first one is how they choose the accounting policy or the accounting methods. The second one relates to the accounting estimates. It's not the same thing. The accounting methods is not the same thing as the accounting estimates, and we are going to explain. And the last thing is the real transaction. Actually, 1 and 2 do not relate with what we really do, what we pay, what we buy. They relate with how we show this transaction in the accounting books and when we show them. Whereas the third one relates to real transaction. Do we actually perform maintenance? Do we actually perform research and development? Whereas first and second relate when we choose to perform, when we choose to show the maintenance in the financial statement, in this year or in the other year. So this has to do with a difference in the inner substance of these three categories. Okay. There are other things that are mentioned there, but they are more specific and they are not part of these three broad categories. For example, timing of adoption of standard, it can be a different time in order to suit some intention of the company. Choices about display, aggregation, classification, disclosure, and so on. So first, what is the accounting method choice? Now, we know that that is present when the generally accepted accounting principle allow us more than one accounting method. They are also known as accounting policies. For example, the choice of depreciation method, you can choose between basically straight line and reduced balance or double-digit method, or you also have the units of production method. So basically you can choose, and this brings differences in the amount of expenditure you are going to report. In the straight line method, you report equal expenditure over the years, whereas in the reduced balance method, you report higher expenditure in the first years of the equipment and lower expenses in the last year of the asset or the equipment. Now remember that in total, over the useful life of the asset, the total depreciation is the same, but you have chosen to report it more in the previous year and less in the last year of the asset. Why do you do that with the reduced balance? Obviously for tax relief reasons. If you charge higher expenditure, you will have lower profit, you will pay less taxes. Okay, so that's clear. Another choice that you have is the inventory, fit or weighted average. And for example, choice whether to capitalize or certain expenditure or recognize them in the income statement. For example, some items of research and development, software, advertising. The standard actually requires you to capitalize these items if you can show for certain that you are expecting an economic benefit from this expenditure. In case you do not expect an economic benefit, you have to expense them or include them in the income statement in the period. So if you include them in the expenditure, you increase the amount of expenditure and lower the amount of profit cut. If you decide to capitalize them, even though they do not have any economic benefit they are going to bring in the future, still you decide to include them in the balance sheet instead of the income statement, you increase the profit and therefore you have increased your bonuses and the value of the shareholders by increasing the price of the share. So you see that there are accounting policies that you can choose to make a better life for yourself, not for the company in itself. Choice regarding the valuation base, we also mentioned that, and also remember something. Usually companies use or apply the accounting methods really with discretion, because the IS8 International Accounting Standard number 8 that governs the accounting methods, policies, and estimates, it requires you to change the accounting methods and to apply it retrospectively. That means that in case you decide, for example, in case you decide to change the depreciation method from straight line to reduced balance, you will change 2021, the current year, but you also have to restate the figures of 2020, the previous year. So you start to restate from the earliest period reported. And if I can go back, you will also change 2019, because the opening balance of 2019 is going to be included in the statement of changes of equity always. So basically, if you change a very small item in order to have an impact or to manage your earnings, the standard requires you to apply that retrospectively in the past, and this is done with the purpose to refrain or to contain and do not encourage the management to perform the changes through accounting method choice, if you can get that. So it's a tool, the managers can use that, but still they have to restate all the amounts of the previous year. And this requirement from the standard is made only to refrain and to constrain the choices of the managers. As we said, IFRS are a very qualitative financial reporting standard, and they represent this requirement to retrospectively adjust figures in order to discourage the management from having these initiatives like this one. Again, we have the second option, that is the accounting estimates. According to the IS 8 standard, this is not adjusted retrospectively. That means that if you make a change, you are not going to go back in the past and change and restate those figures as well. You just restate the amounts of the current period. Now, what are the accounting estimates? Actually, they are not related to different methods, but they are related to the estimates that we do about specific cases. For example, related to the bad debt allowances, you know that a certain percentage of our trade receivables are probably not going to be collected. How do we know that? From past experience. We always know there are clients that are not financially viable, they will not pay their invoices, so will not collect that money. So the accounting standards has provided some room and some option for the managers to decide what percentage of the trade receivable you are not going to collect. So this percentage is up to the managers. The standard itself allows this, and it gives the managers room to decide for themselves what is this percentage going to be. I say it's going to be 5% because during the last 3 years it was almost 5%. But someone else, another manager, can think that it's better to decide it's 10% on sales or 10% on trade receivables. You see that depending on what we choose, sales or trade receivables, it's going to give us a different number of the bad debt allowances. But this means that this is something that the managers can choose. They can decide and they can change. 2020, for example, may have a bad debt allowance at a higher rate than 2019 due to the pandemic effects. And that's okay, that is justifiable. That becomes or comes from an obvious reason. But what about the other years? And what is the impact of the bad debt allowance, if someone can remind? If you increase the provision for bad debts from 5 to 10%, that means that you increase the expenses of the year, and that means that you decrease the profit or reduce the profit. And this is an excellent tool to take a big bet for the current year. In case you have seen that 2020 was not successful and you are going to report a small loss, make it even bigger, to take a big bet in 2020 and then to say or to show yourself for the future years in a better, favorable light, if you can understand. Bad debt allowances is one, inventory is another one. We can change the estimates of the overheads that we can allocate to the inventory. You remember the discussion that we had together when we covered IS2 regarding inventory? We discussed about the overheads, the variable and the fixed overhead. For the variable overhead, it was nothing to worry about because Variable overheads are going to be allocated according to the actual capacity, whereas the fixed overhead, which represent the highest part of the total production overhead, according to the standard, they should be allocated based on the normal capacity. And of course, there are different incentives for the company out there to regulate and change the normal capacity. What is the normal capacity? They can change that so they can allocate more expenditure to the inventory. If they allocate more expenditure to the inventory, they do not charge this overhead as expenses in the income statement. The profit is represented higher and the price share is going to be larger. If you can get all the meaning. Any questions so far? Provisions as well, provisions for litigations, provisions for environmental impact and so on. The IS 37 that regulates provisions, something that you discussed in the first part of the course, the IS 37 about the provisions deliberately says that it is assigned or decided according to the discretion of managers. Whenever you, as managers, you forecast something that is going to bring losses in the future, you have to provide now. So whenever you have incentives to increase the profit for this period or to decrease the profit, you change the amount of the provisions. That is a common tool or technique used by the managers. Choice of residual value and the useful life of the assets. In case you change the residual value, the value at the end of life of assets, or the useful life of assets, whenever you change these two components, you can change the amount of depreciation expense. And for many companies, I think that you verified that in your own cases, for many big companies, the depreciation expenditure is one of the largest. They have big investments in equipment, and therefore the depreciation expense represents a very large amount. A simple change in the useful life of assets or the residual value can have a big impact in the depreciation expenditure. Impairment as well, that is connected with the with the long-term assets, non-current assets. If you decide that a certain asset will not bring economic benefit and will not recover its value, you can impair. But impairment expenses also means charges for this year and lower profits, in cases you want to have years with big bets. As we mentioned, accounting estimates are preferred and favorites from managers because they do not require retrospective adjustments. You are not supposed to change the previous years. Okay, what are the real transactions? I think that we can complete this chapter before the break, 5 more minutes. I know that maybe it's long, but 5 more minutes we can, I think we can focus and complete this chapter. The real transactions that impact the future period, they are related to deferring investments or discretionary expenses. They are at discretion of the management. They decide if they have to spend for advertising, research and development, or repair and maintenance. In case they do not spend this money now, no immediate effect is going to be verifiable, but in the future years, this is going to impact the operational capability of the company. If you don't spend for repairing and maintenance of equipment, for the current year they may go operating just fine, but they may have some major breakage in the other year. So these are known as discretionary expenditure because the management can decide the amount of expenses without affecting immediately the current period, but its impact is going to be visible in the longer run. You don't spend for advertising now and maybe you continue to sell, but in the other year, without good advertising, you are not going to sell. So there is this connection between this line of expenditures and the future operating performance. You may defer payments, you do not pay deliberately, and you keep the money to invest in other items. You structure acquisition in certain ways as to impact the structure of investments. You do not invest in this year, but you defer the acquisition for the other years. The content of contracts, for example, it's not a leasing or a renting. if it's a leasing, it should be under the new lease standard, it should be included in the financial statements, even if it's not a capital lease. But if it is just a simple rent, it will not be included. The sale of an asset is going to be sometimes in those years when we need extra money to recover or to cover up a loss transaction in another part. Related party transaction, overproduction to lower production costs, so operating at really very high actual capacities, really beyond the normal capacities. Now remember that the real transaction do not have a reversal effect. These happen or don't happen. And in the future they are not going to change or to have the reversal effect that we are mentioning. Whereas the accounting method or accounting estimate choice, they impact the short run, but in the long term, they will have a reverse effect. As we explained with the depreciation example. If you change the depreciation method from the straight line to the reduced balance, you just appropriate or change the amount of expenditure in different years that overall, over the useful life or the time span of the asset, you have the total or the same exact amount of depreciation. So there comes a time when it will be visible the reverse effect of the choice that you have made. Okay, the entity analysis, I don't want to go into detail because I think that you already covered this in part 3 of the textbook when you covered the consolidation accounts. So you have discussed about the level of control over an entity, over a subsidiary. If it is more than 50%, it is control, and then you fully consolidate the financial statements. If it is between 20% or 50% or lower than 50%, but you can demonstrate that you have full control, you still fully consolidate. If it is between 20 and 50%, but you only have significant influence, you account by using the equity method. And if you have no influence, usually less than 20%, you just include them with the cost method in financial statements. Okay, more about the reversal effect that I previously mentioned several times, but here now it is explained what it means. The account management have a reversal effect, meaning that they will just be deferred until a future period. In case we change the depreciation method, it means that I'm just anticipating some expenditure, but there will come a time when the depreciation expenses will be lower. So it is just a matter of time to reverse itself. Many methods only provide these temporary changes in number, and actually managers who engage in earnings management know this fact. And they know that they are going to reap the benefits of the first year, and when the reversal time comes, usually they change company. They appear to be very successful in a certain company by engaging in accounting manipulation, and when the time of reversal effect comes, they usually are gone from that company into another position, into another company, having another very big salary, and leaving the next manager that enters the company to have the consequences. Usually he will suffer the wrong choices of the previous manager. So remember that this is only temporary. The only thing that does not reverse or is undone is the real transaction. The third category, whether you choose to pay or not, whether you choose to make an expenditure or not, that is something real. It's not connected to the way that you choose to represent this transaction in the financial statement. So usually the real transaction, discretionary expenditure, buying subsidiaries or not, investing in equipment or not, they do not have an annulment or a reversal in the future. Of course, the quality of disclosures, that is something that we really discuss a lot, and it relates to the overall elements that we are talking and covering. Explanation of significant changes, level of information disclosure, description of accounting methods and accounting estimates. You may find that sometimes companies are really very detailed and serious about disclosing how they have calculated different items. And if they have changed the accounting method, why did they do that? So sometimes companies are really serious about that and give information, but sometimes they are not. Okay, more about non-GAAP measures we are going to cover in the next chapter. That is the extra chapter about the key performance indicators and alternative performance measures. So we have a small break and then we start with the next chapter. Any question? No. You are very quiet.
其实想知道谁拿了100。
我也是，我觉得绝对是第2年的，不然的话咋可能这么短的时间？对，真的，可以了。
最后那一组，我看他们分数很高，19小组，但他们组里面是不是有一个，好像是几个没，反正也是有几个没拿，有几个挂了，里面就一个过了，
没有吧？
真的。因为我闲的无聊，我就在那对比那个学号跟组嘛，我一看，有的是找不到他们的人，有的是整个挂掉的，就白瞎了99分，但还能再考一次。
我觉得那个我们小组这个女生呀，应该也是第2年，我感觉。
反正肯定之前考试没
对，而且好多本科就是这个专业的，你学这个很简单，对你像我们这样一次都没接触过，真的很难。
如果假如说你的那个 pre-course 学的也特别扎实，其实那个也没有那么难，但是咱们
那个怎么可能？
为了考试。
对。所以我觉得我们学习能力要是比起他们学过的人来说，考的这个分数，其实你已经很厉害了。我觉得是这个，我觉得自己真的应该是很努力了已经。
你已经很不错了，但我觉得我们的小组作业的分差的太多了，就是应该再会更好。我觉得大部分的分是扣在了我们超时。
这次一定要注意。
这次我感觉更难，
这次更多。所以这次要提前演练很多次，对，就一定要把时间卡对了，
对，
不能那样就提前10分钟试一下就走了，这样我觉得不行。
老外也不知道。
要不就跟他们说一声，就我们提前多弄几次啊。
现在那中国女生昨天晚上才开始做。
没有吧？
就那个我们那中国的女生，说是昨天晚上才开始要准备，我就在担心。
啥时候才能把这做完？
对啊，因为他的那个部分是第5个，第6个是就是聊的，是有一点跟之前讲的是有点类似的，什么壁垒啊，什么这个一个简介啊，什么这个 benchmark， 什么这个。什么这个乱七八糟的，我也忘了是啥来着。他在这能觉得是就是跟那个 introduction 那边强调的直接跟不一样。introduction 那时候我做的时候，我做的那个部分就很简单，根本就不是一回事。我觉得他可能觉得太简单了，但是明天就很简单。
没事，他今天能做完就行。明天早上，要么今天晚上之前。
我跟你说，那个拉不太动。昨天晚上就在群里说，我说别忘了改那个，还有就买之前那个东西，别忘了把旧的删掉之类的。这样就可以按照上次一样的，就周4、5点最多的提交。当天明天我就能改了，我可以中午提交。
给我们点时间呀！
赶这个早呢，对不对？不懂。
我觉得得跟他们说，有些时候有些人可能就没有想到，所以可能一定要说出来，然后才会有意识，我觉得也挺重要的。我觉得我们得真的要提前来上1-2遍才可以。我现在我那个 part alternative 我还没法做，我都不知道该怎么做呢。我今天听完课我才能把它做出来，所以就没办法。没事，我们可以的，相信自己。We can do it。我觉得你现在宝贝，你就应该在群里要跟他们说一声，就今天晚上一定要把之前把这做完。
Actually, you have that uploaded on Moodle already. I included as an illustrative example the case of WorldCom. It's another big company and it was famous for its bankruptcy. Again in 2002. It was also audited by Arthur Andersen and it was known for managing using the line costs. So basically what they did is that they started in 1999, sorry. The company audited by Arthur Andersen, they did not understand anything while auditing the financial statements. You have everything described there. It's a very interesting example as well, along with that of Enron, of big companies that engage in earnings manipulation and the auditing. Companies do not get or do not understand what is going on. Therefore, the analysts should be very careful in understanding actually the lines, what is going on over there. Of course, I will let you read for yourself. It's like a case study or an example to see that actually the analyst can go beyond the work of a single analysis of ratio, but understand what is going on with the line items of companies. For example, this is a simple common size analysis, like the one that you are performing for your own companies right now. What it is interesting to notice is the huge increase in the net or gross property, plant and equipment. From 97 to 2001, it was from 30% to 47%. Normally, this means that the company is obviously capitalizing their many expenditures. So a further investigation of this line item could have found out the motives or what was really being hidden in this line over here. So curious analyst in 1999 might have wondered why is this huge increase that does not go in line with other actors in the same industry or with other line items. So of course this was, as I said, to illustrate okay, so the last chapter that we are going to explain, you have seen that this is not part of the textbook, right? So for the ones that want to read more about the calculation of the key performance indicators and the alternative performance measures, for those that want to read more, I have uploaded on Moodle an optional extra reading for you to read. It is not mandatory, you are not required to do that. If you only read what is included in the PowerPoint presentation, you can have all the information we need to know at this point about the situation of non-financial reporting. I bet that while you are preparing your group work project, you have seen many indicators or ratios that are not financial. They are not performance related, they are not turnovers, or they are not current ratio. But actually they deal with other areas such as environmental, climate related, social inclusion, and representative of the discriminated ranges from the society. The companies are really liking their idea of disclosing this non-financial information, but the problem is that they are not regulated. So no companies, they are not required to report on specific indicators. They are making and creating these indicators according to their needs, according to what they perceive is important to disclose. So this is a field that needs vast regulations. And we have to keep this in mind as we talk and speak about the non-financial reporting. So we are going to talk about assessing financial performance and discuss the need and trends in non-financial reporting. There are many agencies, there are many interested stakeholders that are involved in issuing standards about sustainability reporting. You can see standards that are issued by UN or by European authorities. So which one should we comply with in case we adopt the sustainability reporting framework? There are different trends that exist. We are going to learn more about environmental reporting, the social reporting, what is known as corporate social responsibility. And then we are going to talk more in depth about the sustainability and what we recently know better by the words of integrated reporting. Integrated reporting integrates and connects together the financial performance and the non-financial indicators. The problems that we mostly encounter in the annual reports today is that there is no connection between a financial indicator and a non-financial indicator. You have the information about the profit margin, and then you have the information about the gas emission in the atmosphere, and You have no connection between them. There is no information that makes you think that, okay, in order to keep the gas emission at this certain percentage that is required by the state, what is the cost that I've been paying to keep the gas emission? And maybe this cost has made its impact in the gross profit margin or the net profit margin. So there is no connection nowadays between the financial and non-financial indicator, and it's not easy to understand how one affects the other and vice versa. This is something that obviously needs to be regulated. And by the end of this chapter, we are going to distinguish some items of integrated reporting that have an impact on the overall performance of the entity. The contents, we will start with mentioning what the key performance indicators are, but we know them and we are just going very fast through this point. Alternative performance measures that relate to non-financial reporting. Non-financial reporting actually connects to these four, you can think of that as four dimensions or four circles that surround each other. Like we first start with only environmental reporting and climate-related issues, and then we expand it further into social reporting, and that is expanded further into sustainability reporting, and the last, the more inclusive approach is the integrated reporting. So what each of them includes and actually needs to be disclosed in the financial statements. What we know is that we can appraise and assess the performance through using different key performance indicators. This is a very simple summarization of what we know so far. So we use ratios regarding profitability, financial status, investment potential, and cash flow ratios. And we combine them together to understand what is this company going through. Is its liquidity okay, solvency, performance? What about the perceptives of investors? How do they perceive this activity or the performance of this company? But actually beyond the KPIs, and I've illustrated the key performance indicators with the Carrefour company, you see that sometimes the companies choose to disclose some of the key performance indicators in the financial statements. And the Carrefour has recorded and disclosed for the last 5 years, so not only for 2020 and 2019, but starting from 2016, they have disclosed the capital, the results from operations, the net income per share, and so on. Of course, the company will not disclose every ratio that we know of. They will not calculate everything that we have learned in our course, but they will disclose those key performance indicators that they think are more important for their activity. Maybe also your companies, in your cases, have chosen to also report different items or different indicators. But what are the alternative performance measures on the other way? An alternative performance measure is understood as a financial measure of historical or future financial performance, financial position or cash flows, other than a financial measure defined or specified in the applicable financial reporting framework. This is specified in the paragraph 17 of the regulation of European Stock Market Authority. There is a directive or a guidance issued in 2015 from ESMA Authority, and they, in their paragraph 17 and 18, they are giving information about the alternative performance measure. The problem here is that this authority, the European Stock Market Authority, they observed the market and they saw that many companies were providing this alternative performance measure. What they are, we are going to present in some minutes. But these alternative performance measures, they are based on non-audited information. They are based on information that is not complying to the IFRS. That means that we should be very careful when we use these measures. And therefore, the ESMA felt that it should intervene in this situation and put forward some requirements, not about the way that these alternative performance measures are calculated, but actually the way that they are presented and included in the annual reports. So the APMs are usually derived from IFRS figures from amounts that are not calculated and disclosed according to the standards, but beyond following the IFRS standards. And this has become very popular for companies. I think that while you are going through your own cases, you may have find several figures that say non-GAAP or non-IFRS. I will show a case later where we have indicators both non-IFRS and IFRS based. As I said, in 2015, the ESMA issued the guidelines to report the calculation and reporting disclosure of ATMs. Even though it was issued in 2015 and effective from 2016, actually there are many areas where there is a significant need for improvement. And in 2019, we have a report of the results of applying this guidance in practice, and they actually did a survey with many companies in Europe and to see if this was effective or not. If you are interested to have the ESMA guidance of 2015 and the ESMA report of 2019 on the results of applying the guidance of the ESMA, let me know and I will upload that in Moodle. I haven't done already because I think that you are overwhelmed with too much information. But in case you want to read more about APMs, it's very interesting. You can ask me to upload on Moodle, or you can find for yourself online. It's easily accessible. It's not proprietary. You can just access and read everything. So what we see is that still after the guidance issued in 2015, many companies use different types and different numbers, different figures for calculating the alternative performance measures. And they also put different names on these alternative performance measures. The problem is the same as exists with the key performance indicators. We saw with our ratios that sometimes it is one name, for example, total debt ratio, and sometimes the same ratio is known as the gearing ratio or the leverage ratio. So it is almost the same thing with the APMs. Different names, different labels applied from different companies, and as we can expect, also different formulas, how to calculate and how to find out the same report. The most widely used and the most widely found in the annual reports, APMs, start from the cash earnings. As you may understand, the cash earnings is the figure of the net profit which is cleared from the accruals effect. But actually it's not the cash flows from operations. Basically the cash earnings is the net income that the company can calculate if it follows not the accrual accounting concept, but if it follows the cash accounting concept. Now clearly that is not according to IFRS at all, because IFRS and GAAP require us to use the accrual accounting. Whereas if we use the cash accounting, which is not allowed, we would arrive at the cash earnings figure over there. So the companies calculate these cash earnings and they disclose that in their financial statements. Is it reliable? Should we base our interpretation on this? Who knows? So this is a problem with APMs. They are not based in IFRS or GAAP. So we don't know to what extent we can rely on these indicators. And on the other side, they are not following IFRS, and keep in mind, they are not audited. The transactions included in these figures are not submitted and are not subject to auditing procedures as the auditing standards require. So this is another big problem you have to keep in mind. The EBIT, this is an item actually that it's not an APM in itself, but it's an item in the in various income statements. When it is not, we usually calculate EBIT, nothing to add there. What is more important is EBITDA, earnings before interest and tax, but also before interest, tax, and depreciation and amortization. Now, EBITDA is considered as a very important APM, and sometimes is also included in the analysis from certain financial analysis reports that you may read. Why is it important is that this is a level of earnings before we apply the amortization and depreciation expenditure, which may differ from one company to the other depending on the level of investments they have in different various of items of non-current assets. So if we take an earning which is before interest and not taking into consideration the financial structure, before taxes, so do not take into consideration the fiscal effect of fiscal choices, before depreciation does not take into consideration the operating investments that we have done, that is an earning that I can use to compare different companies together. So it's a better level of result than EBIT to compare companies together. As I said, for many companies, the amount of depreciation charges can be very high. But for another company, it can be a lower amount because they have less investments in equipment. That is not really realistic, so when we try to make them comparable, we jump to the EBITDA. Again, when you may read reports for financial analysis, you will very often find EBITDA used as an indicator to compare companies to each other. Why? Because it's a clear result. It's before the impact of the financial structure, operating investment structure, and the fiscal choices. Okay, the other one, very famous, is the net financial debt. Now, you can see that it's very logical and it connects and it links to what we may call as to our net obligations. It is the difference between the debt and the cash and cash equivalent. That is, in a certain moment, if I consider all my debts and loans and I deduct the cash and cash equivalents at hand, what is the net financial debt that I owe? This is like the net liabilities that I would need to pay if I already spend all the reserves in cash and cash equivalents. So usually we'll also find the net financial debt calculated and reported. This one is very famous as well, free cash flow. I think that you will listen about free cash flow very often. Free cash flow basically is the difference between cash flows from operating activities and capital expenditures. In practice, you can calculate free cash flows at two different levels. You can calculate free cash flows for shareholders and free cash flows for the firm or for the company. The free cash flow for the shareholders is the one indicated there. So basically the difference between how much cash I have generated from operating activities, less how much I already spent to buy new investment, that is capital expenditure. The difference, the free cash flow, is usually compared to the amount of the dividends. That means that the free cash flow is the money that is free to use in other needs of the company, if you can understand it. So this is the CFO, the money that I generate from my normal operating activity, less what I use to invest for capital expenditure or for new investments. The money left is labeled free cash flow. I can use that for whatever I need as a shareholder, as an owner of the company. Basically, the free cash flow should be used, ideally, first to repay all existing debts, second, to make some plans for future investments, and then to pay for the dividends. So the maximum amount of dividends the company can declare is the free cash flow. You usually, in financial analysis, you usually compare the dividends to the earnings, because you say that the company will declare dividends whenever it has calculated and reported profit. And that is true. You usually compare dividends with the profit, but the capacity, the capability to distribute dividend depends on cash. Do you actually have cash to pay the dividend? So you have also to compare the free cash flow to the dividend. Another level of free cash flow is that available to all the firm, and basically is the free cash flow to the shareholder adjusted by the interest expenses multiplied by less the percentage of taxes. I have not included that one here, just to not overwhelm you with too many information. But remember that the free cash flow is one of the mostly used alternative performance measures. It shows how much money do you have to use. It's available to the company to be used for different purposes. Mainly, there are three distinctive uses of this free cash flow. First, repay existing debt. Second, make planning or structuring reserves from future investments, and only the last one, the third one, is paying dividends. So this is the last thing you should do. Another one, this is also very famous, is the underlying profit. Now, what basically the underlying profit is, this means different things for different companies. And usually the companies, in their notes of the financial statements, they will show and disclose how they have calculated the underlying profits. Sometimes you may see that as an adjusted profit. And usually the company will say that the net income according to IFRS is this one, and probably it may be a net loss. But if we do not take into account this one and this one and this one, and they give good arguments for several expenditure not to be taken into account, it comes out that the underlying profit is higher than the net profit reported according to IFRS. So basically what the company is doing is trying to minimize the effect of the net income or net profit reported under IFRS. Basically what ideally should be, the underlying profit should represent the amount of the result that is recurring year after year, that is including items that are expected to happen in the operating activity of the company year after year. Basically, it should exclude those items that are not going to be repeated, that are not recurring year after year. But companies misuse the opportunity to report the adjusted or the underlying profit, and actually they include there also items that are not actually non-recurring. Another APM is the autonomous growth or similar items denoting adjustments to line items of statements of comprehensive income, income statement, and so on. So these are like the basically most important, most popular APMs that you are going to find in the financial statements. In the tutorial tomorrow, I have posted the tutorial 6 on Moodle yesterday. I know that you didn't have time to go through the contents of this tutorial, but there are several cases and illustrations when we are going to see these APMs, how do they blur the interpretation of financial statements. If we take into account only the KPIs or only the APMs without interrelating them together, it is difficult to arrive at a conclusion about the company. So tomorrow we are going to have some examples and illustrations how to use the APMs in the financial analysis. Something that I needed also to add is that although the ESMA guidelines, as I said, has tried to implement and introduce some guidance on the APMs, there are several requirements according to the disclosure of the APMs. And according to ESMA, the issuers or persons that are responsible should define these measures as well as the basis of the calculations that is adopted, including details of any material, hypotheses, or assumptions needed. So basically what the companies need to do is that they have to disclose the basis of calculation and how this connects to all the financial background and information of the company. This means that the companies should not only just present the APMs there without no explanation, but they have to give vast disclosures about the way they have arrived to these figures and why they include that in the reported financial information. The presentation of these APMs should be very clear. The definitions of all the APMs should be disclosed in a clear and readable way. So the information should not be not clear and should not be misleading. The APMs disclosed should be given meaningful labels reflecting their content. That means that companies are now less likely or are more limited to the possibility to name the same APM with different name, different label, because they may introduce an alternative performance measure and they like the name that they are putting to this measure and they just put that in financial statements. With the new guidelines of the ESMA, this is not so easy to do any longer. So they have to be careful and exercise caution how they label their indicators. The reconciliation is also needed. That means that if you provide, for example, the underlying profit or the adjusted profit, you should make the reconciliation between the reported net profit following IFRS and the underlying profit. What items basically of expenditure or revenue have you included or excluded from one of the indicators? So you should have to report this. And ideally, this should limit the companies from providing too many APMs. When you require them to reconciliate the items with items already included in the audited financial statements, there is less possibility or room for the companies to misuse this freedom they have. Okay, and the reconciliation as well that I mentioned. Issuers should also explain why they believe that this APM is useful and provides more information about the users of financial statements. Comparative and consistency. This is something very important in financial reporting. Whenever we have financial information, we need that to be consistent over time, because that guarantees the comparability, the ability to compare results over time, and that connects and applies as well to the alternative performance measure. So if a company chooses to disclose the underlying profit, it should disclose that for all the years that it has reported information, and it should apply the same formula and the same approach to calculate the underlying profit. So it is consistent and it can be compared over the year. In case there are changes, they have to explain the change, they have to explain the reason of the change, and they have to provide restated, retrospective, comparative figure. Again, this limits the company from applying different calculations and changing the method of calculating whenever they want. So if you can see the guidelines of ESMA to regulate and their efforts to regulate the alternative performance measure mirror and are very similar to the attempts of the IFRS board to issue standards that regulate the financial information. So that's basically something that is trying to regulate the market over there. Also, if the company of an issuer stops disclosing a certain alternative performance measure, he should explain the reason why. So in case you decide not to disclose the underlying profit anymore because it's not a profit, it's a loss, you should disclose why. So it's not easy to go out once you are in and deciding to report some APMs. It's not easy to just discontinue that disclosure in the future. The benefits of all these indicators, when they are related to so many requirements, you may ask, okay, what's the benefit of using the alternative performance measures? Okay, they can have many benefits, like helping to evaluate an entity, enabling comparison between entities, and also they have some drawbacks or disadvantages. As we may mention, the entity may calculate an APM in a different way year on year. Now with ESMA guidelines, that is not possible anymore. But two entities may still calculate the same APM in a different way. The ESMA guideline does not say you that to calculate the underlying profit you should exclude 1, 2, and 3. They just ask you to apply the same consistent logic and rules over the years, but they do not basically tell you how to calculate the ratio. So this is still a problem over here. Entities also tend to provide very little information of how they have calculated an alternative performance measure. They are required to reconcile the figures, but they provide as less detail as it is possible for them. Probably you have noticed this in financial statements. Sometimes when you want to know some information, simply it's not there because the companies tend to disclose the minimum amount required by the standards. Also, this is very, very true. The APMs tend to be selected and presented in order to present an optimistic picture and a situation of a company, which is not really connected to the true performance, what is really going on. Too much information, on the other hand, can be confusing, and I think that you all agree with that. You are dealing with too many ratios right now, and on top of that, having also some alternative performance measures to include in your picture and background and to analyze all of that means too much information, and that gives the exact opposite effect. Actually, it does not help to have a clearer picture, it just blurs the reality to have too many information. It might be confusing. Sometimes giving a certain alternative performance measure prominence may mislead users of financial statements. It was a time when free cash flow was really very famous and popular back in the 2000s of the last decade. Free cash flow was everywhere, calculated everywhere, and it was given too much more prominence that it really is important. Or there is another indicator that now it's not being used anymore. It was famous also in the 2000s. Economic value added, EVA, if you try to look for that in the internet, economic value added was calculated by all companies back in the 2000s, not anymore. So please be careful that there may be indicators in fashion for a short time, but not continuing in the long run. Of course, we have to keep in mind always the limitation of the financial information. That means that I'm not just disregarding the work that you are doing. Just a reminder, class and the ones that are following, we have class until 12:30 today, right? Okay, so we have 20 more minutes to present, and I really hope that I will finish this chapter in 20 minutes. So in order, when we restart at 2 o'clock this afternoon, we are going to deal only with the exercises, okay? So I'm just trying to finish the chapter in the 20 minutes that we are left with, and then we will continue with the exercises. So this is the limitations of the financial information. It does not include all the important transactions, does not reflect any future event, it's focused only on the past, and it's limited in predicting and forecasting the future performance. And you might have noticed most of the financial information is almost outdated by the time it is published. For example, for those of you that are using financial statements published on or for years ending on 31st of December, we are now in beginning of November, so it's like 10 months after these things actually happened. Whatever I'm calculating there, whatever ratio is there, this is 10 months old at least, so what's the value of using this information? So this is a major drawback of actually financial information. Also, other limitations in using the financial analysis is that profit is highly dependent on the accounting policies. We mentioned that profit is easily manageable, the earnings manipulation that we mentioned the previous chapter. Also, many businesses produce financial statements to a date that has no relation to their cyclicality or seasonality of the trading activity. They are trying to adjust actually, but not all of them have the freedom to do that because they have to abide to the legislations of the countries where they have incorporated, where their headquarters is registered. Also, the ratios that we are using, as we said, are based on historical cost and do not give a true picture of the trends. We are trying to use ratios from the previous year, but still, a trend of only 2 years is not enough to have a full picture of what's going on in the long run, right? Another thing is that comparing the financial statements of similar businesses can be misleading because of the size differences, the strategy that they have adopted may be different, or the different segment lines, different segment businesses that are included in each company makes it impossible, almost impossible, to compare two companies together. And of course, we have to remind about the differences in accounting policies. One company may have chosen the cost, whereas the other company may have chosen the fair value method to account and represent the long-term assets. Terminology, presentation, a simple change in terminology that may be a lot misleading. Stock. What do you understand when I say stock? if I say stock, what does that mean for you? I'm just trying to illustrate the differences in terminology. What is stock? Come on, it's easy. You understand shares, right? Okay. In UK, stock is inventory, for example. So if you have a UK company, I don't know if any of you have, if you see stock there, it's not the shares, it's the inventory. And like this, there are vast differences and vast changes in the different names. But just to illustrate something, this is the reason, because of the limitations and drawbacks of financial information. This is the reason why in the recent years, like in the recent 10 years, the non-financial performance measures have become so famous and so popular. You see, many companies are including non-financial indicators in their annual reports, and sometimes you may not understand why. You are looking for I bet you've had the same problem as me. You are looking for the income statement, and then you see pages, 60, 70 pages of information about segments, about value created, about impact of environment, about impact on community, and then you find the financial statements by page 100 and 150. So this is how important the financial measures are becoming, and the non-financial information is becoming. First, we present the non-financial information trend, and then the initiatives to try to regulate the information that is provided in this scope or under this area. It is of increasing importance because of several reasons, and for example, some instances, when you read your annual reports, you may have found information like number of cases of environmental spillage per year, when you have made damages in the environment, reduction of CO2 emissions, amount of waste arising from packages, for example, employee turnover. This is a very famous indicator. Most of you may have read in your financial reports. Training time per employee, or sometimes the amount of training expenditure expensed per employee. Sometimes they also record that. Or lost time injury frequency rate related to employees as well. These are some non-financial indicators that are used and included in the financial statements, but of course there is a large diversity that exists, and you may find other indicators in your cases. Okay, this is Carrefour, for example. Carrefour has, before it discusses the financial information, Carrefour has financial statements by page 70. Before you arrive at page 70, you have to go through this information over here. So that is summary of non-financial indicators. And Carrefour actually discloses 2020, 2019, and the target as well. So you can have like a comparison of the trend, but also to the target that they have imposed. Of course, there are different areas of non-financial reporting indicators. I'm not including everything there in the slides. You can read for yourself. For example, for the products, they have to develop agroecology, organic products, and fair trade. And there are several indicators that they have developed and tried to target and achieve over the years. For example, the quality lines, number of partner producer, gross sales, number of own brand organic products in connection with local suppliers, and so on. Another major commitment is to stop deforestation linked to the procurement of and they have also developed other indicators in this other commitment. You can see that not only for products but also for operations. They have commitments, they have developed indicators, and they have put targets over there, and they disclose if they have achieved this target or are they working towards achieving this target or not. So this is only to illustrate how the non-financial indicators are becoming increasingly important. So the reasons are because shareholders are more and more interested to know how the business is managed, its future prospects, the policy on environment, because the shareholders and the customers in general are becoming more aware about the impact of each corporation in community, in the planet, in the environment, in the general health of the employees and so on. What is also known as social responsibility. Except for the shareholders, the regulators, the consumers, and the pressure groups, for example, different NGOs, they may exert very high pressure on different corporations, for example, not to test on the animals or to use fully recyclable packaging materials, but all of these have an impact on the cost of the company. They usually imply the increase in the cost and expenses of the company. So this is why the non-financial reporting is becoming increasingly more important. It is becoming reported. We see that before the financial information because many related stakeholders are interested to have this information. We also have in IFRS, there is the practice statement 1. Remember that the practice statement under IFRS do not have the binding power of the international standards. So they are not mandatory, they are not required to be applied, but the company may choose to apply them. The management commentary, what we know differently as management discussion and analysis, is not mandatory, but it provides a kind of framework for preparation and presentation of management suggestion and management summarization. They supply information that is presented in the financial statement and explain different factors that might impact the performance and position in the future. But be careful, the information in the management commentary is not audited. That means that the managers can present there an increase in the return on equity. But when you calculate the return on equity, you do not see the same values or you do not see the same trend. That is because they may have been taking different values to calculate the return on equity that is not necessarily the same that should be included according to the IFRS. So be careful when you read the management commentary is right at the beginning of the annual report. The first thing that you see or read in an annual report is the management discussion and analysis, or otherwise known as management commentary. The first inner ring of the non-financial information is the environmental reporting. It relates to the disclosure of information in the published annual report or somewhere else of the effect that the operations of the business have on the natural environment. Now remember that this part of reporting or disclosure does not say anything about the costs the company has incurred in order to abide to the environmental restrictions. It does say only, it discloses something only about the environmental impact, but not to the cost of the company, and that's a big problem for us to link together the financial information and the environmental data over here. There are two means of reporting. One is through the published annual report. Sometimes you may find as part of annual report an environmental report as a separate document. There is no mandatory requirement that governs the preparation or content of the separate environmental reports. What can we find there? What is usually included in these reports? First of all, we may find data about the policies of the company for environmental issues, the policies that are followed, the system the company has in place for managing environmental risks, the identity of the directors that are responsible for this area, perception of the risks, material environment legal issues or litigations, court problems that may have arisen due to the environmental problems. So these are all listed under the environmental issues as part of the environmental reports. The second part is the financial information. That is, what accounting policies are related to your environmental costs. How much are the provisions that we have made to account for the environmental cost? What are the contingencies? So that is expenses that may happen in the future but are not sure about their amount or their timing. Charge to profit or loss for expenditure to prevent or rectify damage. Charge to profit in respect of expenditure to protect employees and society in general. Provisions or contingent liabilities, environmental expenditure, fines or penalties and compensation. All this financial information actually has accounting impact. It should have an impact in the lines and items of the financial statements, either of the income line or the expenses line, or mostly at the liabilities item through the provision and contingent liabilities. So this is basically what financial information is related to the environmental reporting. Again, I took the Carrefour. It was an overall representation because Carrefour had chosen to include the environmental report as part of the annual report, not as a separate document. And you see what they disclosing here is the CO2 emission factors, the environmental information. Of course, the report is not only this slide, it is more, but I've chosen to just to give an idea what the information into an environmental report might look like. Again, it comes before the financial information, so it is becoming increasingly very important. Another circle, a bigger one, it's not the inner ring anymore, it's not the environmental reporting, but if we extend that, it will become social reporting. What is the corporate responsibility? This relates to the process of communicating the social and environmental effects to the community and to the society at large. The corporate social reporting provides data such as, for example, how to provide fair remuneration for the employees, how to pay them promptly, the suppliers, how to minimize the damage to the environment. You see that the environmental is included in the corporate social reporting, CSR, contributing to the community by providing employment or by other means, for example, providing funds for schools or public transport and so on. Many companies do that, and they do report that under the corporate social responsibility report that they present, actually. There are reasons for social reporting. The entity may have chosen to report the social responsibility in order to attract a particular customer base. There are consumers or customers that are aware of the negative impact of corporation in society, and if the corporations tackle this negative effect and they take steps to improve themselves, they will have a better image and will attract new customers. So the companies do this for this purpose. The entity may perceive themselves as being under particular pressure by the government or by different regulators, or they may be really convinced that in the long run this will bring an increase in the needs of the various stakeholders group. You see here the corporate social reporting of Carrefour Company. They have reported the scope of reporting about the corporate social responsibility, how they include some environmental indicators beyond of those included in the environmental report a couple of pages ago. The CSR indicators included how they choose the indicators and the reference they use. Again, this is part of the same annual report. Before we arrive at the financial statements, we find the environmental report, we find the corporate social report of the Carrefour. The business model was by the beginning, if you remember, and so on. The sustainability is like the further extension. So we start with the environmental, then we extend to the social responsibility. If we extend further to the sustainability, so including the future years, we come at the sustainability reporting, which is really a big, huge trend recently. Sustainability, if you are not familiar with this term or with this concept, is the process of conducting business in such a way that it enables the entity to meet its present needs without compromising the ability to future generations to meet their needs. That is not deploying the resources. And that is why all these discussions about leaving a safer and worthier planet for the future generations, and how the company should behave in using the resources in order to not consume or deploy them for the generations to come. This is basically the sustainability. But in order to behave in a sustainable way, the company has to incur specific expenses and specific costs, and they have to report about that. The sustainability report usually is published by a company and includes economic, environmental, and social impacts that is caused by the everyday activities. Of course, it will include highlights of non-financial performance. Environmental, social, economic may be included in the annual report or as a separate document. And as we said, there is a huge increase in popularity in the recent years. There is actually a lack of the framework to regulate the sustainability reporting. Currently, the European Union requires only the large public companies to disclose sustainability information. And actually, this means like 11,700 large companies. The companies that you are analyzing are all within this sample because they are large public companies. Disclosure is voluntary, so not all the business disclose this information unless under particular pressure. But of course, we are seeing a change because information may not be disclosed consistently from year to year. Some businesses, particularly the small and medium entities, may believe that the costs of preparing this additional information is more than the benefits that it provides, and so on. What is actually the truth for the small companies? Updates on sustainability reporting, this is beyond what you were given. In this very year, at the beginning of 2021, the European Commission adopted a proposal to amend the existing non-financial reporting directive of 2004. That means that very soon we will have a new directive from the European Union that will include the non-financial reporting and also the sustainability reporting. So in case you want more information, there is a link over there that you can check and read what is expected to be done in this area. And this is now being taken seriously by the EU and the European Commission. So very different trends that are coming. The proposal extends the scope to all large companies, not only those listed. So there will be more companies that will have to report the sustainability information. Requires the audit of reported information. This further increases the costs for the companies and the revenue for the auditing companies, and introduces more detailed reporting requirements according to the mandatory EU sustainability reporting standards. So again, this is something that you need to check and read for yourself. Is further extra reading just to have an idea what is going to be the trend. That is why we see many companies having the emphasis on the non-financial information of sustainability reporting instead of the financial technical information, which sometimes is considered hard to understand for most of the readers of financial information, whereas reading information about environmental, social impact, sustainability reporting is considered more attractive, more interesting, and that's why we find that in the first pages of the annual report. Whereas the more technical and more specific financial information is by the end, usually the financial statements. Okay, I can see that the time is up, so we are interrupting here. It's not actually much left. There was not much left to the, sorry about that. I just have included information about the trends and what is expected to be done in the EU and European Commission territory about the sustainability reporting. Related to the integrated reporting, if you don't mind, I would like to retake that tomorrow morning. So relating or something about the integrated reporting, illustrated with an actual integrated reporting of the of a real company. I would like to tackle tomorrow morning, if you don't mind. So that is sub-company. This is one of the companies in Europe that provide and prepare an integrated report. What does that mean? We will see tomorrow morning, okay? So